I thought she was saying leap year, and I'm like, why is she talking about leap year? Like, what am I? Like, my brain immediately went to like tax prorations. I'm like, no, Samantha, we're not doing leap years on the test. But yeah, no, that's fine. So, y'all ready to kick this thing off? Sure, why not?
Yep.
Cool. So, we are in everybody's most favoritist section in the entire world, and that is financing. So, we have kind of ripped the Band-Aid on a couple of the big financing discussions, like what a pity payment is, and how basic amortization works, and how you calculate the principal and interest using that loan factor chart. And of course, then we got into the theories, okay? The lien theory states versus the title theory states and kind of what those mean. And so let's just remind me for a second, what type of security instrument does a title theory state utilize?
Deed of trust.
Deed of trust. How many parties are there in this title theory state and this deed of trust instrument?
3.
3. Who are the parties?
The grantor, the beneficiary, and the trustee.
The grantor, the beneficiary, and the trustee. Now, who is the grantor in that relationship?
Us.
Us, the borrower. Why? Why are we calling them the grantor?
Because we're giving it to the bank, and the bank is giving it to somebody else. So to hold it for us.
More specifically, we are giving it, but so we don't ever give it to the bank. We give it to that trustee who holds on behalf of the bank. So remember, when you buy real property, the deed from the seller to the buyer, the grantor to the grantee, right? You would be named the grantee on the deed granting you ownership, but you only hold that ownership for like a second at closing, and then you turn around and you will grant your naked legal title over to the trustee. So it gets granted to you, and then you turn around and grant it to somebody else, the trustee, who holds it on behalf of the beneficiary, which is the bank. Everybody good with that statement? There you go. And so in a lien theory state, what security instrument do they utilize?
Mortgage.
Mortgage. How many parties?
2.
Who are they?
The mortgagee and the mortgagor.
The mortgagee and the mortgagor. Who is who?
The mortgagee.
Shoot.
Would it be the buyer and the mortgagor the bank?
I think it's reversed.
This is reverse. Remember, the mortgagee is never me. You give the bank the mortgage, which is pledging your home as collateral for the debt. You get to retain legal title, but this mortgage says, if I mess up, I know you're still coming after it. Now, what does the differentiation in the foreclosures look like? What do we call the foreclosure in a title theory state?
A power of sale foreclosure.
Power of sale foreclosure. It is easy peasy, lemon squeezy. Folks, they are already holding that title, and they can sell it right out from under you and say, get on out of here, okay? What do we call the foreclosure in a lien theory state?
A judicial foreclosure.
A judicial foreclosure. Absolutely. There you go. Now we're on it. I like it. So, we continued on, and we got into some other discussions. Of course, these deeds of trust and these mortgages, they are liens. They are specific liens attached to a piece of real property. And so remember, a specific lien attaches to the piece of real property, not the person. And so in hopes that, we would satisfy them and eliminate them before we convey clear title, or so we can convey clear title to the next owner. But if we don't, they would be in appurtenance. They would stay on there. They don't fall off unless we take care of the debt or unless a foreclosure happens. I told you, when we were talking about lien priority, a foreclosure does extinguish all the liens against the property. But that allows the person you owe money to potentially go after you by way of a deficiency judgment, which is where they said, well, we didn't get all the money we were owed. We're going after you with a general lien now that goes after all of your assets, personal property and real property. Big differentiation there. Now, do they always go after you by way of a deficiency judgment? No. The other option I told you is sometimes they just forgive the debt, but when they write it off on their end, they would have to report that to the IRS as a loss, which saves them in taxes, and then that would be counted as income for you that you would potentially have to pay taxes on because it was forgiven debt. Now, the last note, North Carolina specific, a deficiency judgment is prohibited in seller financing. So we're going to talk about the type of seller financing that I didn't really get into yet, called a purchase money mortgage, where basically the seller acts like the bank. So if they were to foreclose and take the property back, unlike where the banks actually just sell it at auction to the highest bidder, they would not be allowed to go after you by way of a deficiency judgment. Special legislation in North Carolina that doesn't allow it. So on this same kind of discussion comes up another very specific financing terminology. And you probably heard this before, and it is called a short sale. Now, a short sale, folks, is a very ironic terminology. Short makes you think it happens fast, but it doesn't. A short sale takes a long time. What makes it a short sale is that it is a sale that is short on funds or proceeds to pay off all liens. So in other words, you owe money to different lien holders in total of $250,000, but if you sold your house, you'd only make $200,000. Well, that's not enough money to pay everybody. Now, please understand, if you had $50,000 in the bank, you could just cut a check to the lien holders, pay them off, and be done.
But you thought they had something.
Don't worry, I just muted you. If you could pay them off, you could be done. You could walk away scot-free. However, if you can't afford to pay them off, you might end up going to the bank and saying, listen, I'd like to sell the house, but I'm not going to make enough money to pay you. And I'd like permission for you to let me pay you less than what I owe you. That is a short sale. You cannot do it without the lender's permission. You have to go and ask. You say, Mother, may I sell this house for less than what I owe you? And they say, let me think about it. Now, folks, why do you think they might allow a short sale as a lending institution?
Because they've already made their money off of interest.
Well, that is one very good reason. They've already made a crap ton of money off you off of interest, and so it may not be hurting them as bad as we think. What's the other one? What you got, Jacob? What were you going to say?
Maybe if the the person buying the property also agrees to bank through them.
Maybe. That might be a consideration.
Maybe to avoid foreclosures?
To avoid foreclosures. And there's two reasons why. In North Carolina, with a power of sale foreclosure, foreclosures are not expensive. In lien theory states with judicial foreclosures, there are court costs, and they are lengthy sometimes to actually foreclose by way of a judicial foreclosure. So sometimes it's a lesser of two evils to not have to go to court and do a judicial foreclosure. The other thing, folks, even though it's not the bank's fault that this person can't make the money on their house, if they were to foreclose on somebody, sellers, homeowners who are getting foreclosed upon, they have a tendency to get very disgruntled. So what do? They make it their goal to devalue the property. They destroy it. They paint it. They dump cement down the toilets. They set it on fire. They do all kinds of stuff to try to destroy the value for the bank. So if they are amenable and they work together, then typically the bank still works out better and more to the positive than if they get a property that's completely destroyed and has a zero value. And as Stephanie said, in a lot of instances, they've made a crap ton of money. If you've been in there for 10 years and then they're having to do it, they made a lot off of you.
Hey, Seth,
Yeah.
my husband and I work for foreclosure people and go in and fix houses and stuff when they've been foreclosed on.
You've seen it all.
Oh, no, let me tell y'all a quick story. This is a horror story. So we pulled up to Elizabethtown, and I looked at my husband and I said, I think there's a dead body in this house. I mean, like, it was horrific. And he was like, okay, I'm going to go to the door. I stayed in the truck with my door shut, and he opened the front door, and I started gagging. The smell was horrible. They had taken laundry baskets and put black can liners, trash can bags in them, and were peeing and pooping in them. There was 25 of them in there. I don't know how long they had been in there, but it was horrible. So my husband had to clean that house by himself because Stephanie had no part of it at all.
I think I would have preferred the dead body. I'm going to be honest.
I think I would have too.
Folks,
If it was a dead body, you would have called law enforcement and you wouldn't have had to take care of it.
well, I mean, at least not immediately. Actually, typically they hire cleaning companies too. Yeah, they want to. Yeah, burn it, set it on fire. That's right, Justin. Nope, out. Insurance money it is.
Well, we went to Dollar General or Family Dollar, I can't remember what was the closest, and bought like Febreze bombs. And we put like 100 Febreze bombs in there just so he could go in and get it out. But I still couldn't go in the house. It was horrible.
Listen, Stephanie, that's nothing that a little Fabuloso can't fix, okay?
No, Fabuloso don't fix stuff. And people poop in the air vents. They poop in the back of the toilet. I mean, people are mean.
Yeah, I know. It's nuts. It's absolutely crazy. I don't know. Yeah. So, a short sale. Folks, understand that a short sale and a foreclosure are not the same thing, okay? I want you to understand that. Short sale and a foreclosure are not the same thing. Foreclosures happen because... Sorry, my mustache is like tickling my nose, so I look like a crackhead over here. A foreclosure is where they are forcing the sale due to something you did wrong. Doesn't necessarily mean that you didn't make your payments. That's one way to breach it and kick in that, what's it called when the bank says you had 30 years, but now you owe us the full balance right meow because you messed up? What did we call that? Acceleration clause. There you go. So sometimes the acceleration clause is kicked in because you didn't make your payments, but other times it's not because of that. It could be because you modified it, you lied on your loan application, anything like that could kick that in as well. But with a short sale, sometimes you've done absolutely nothing wrong. So this could be due to economics. I'll give you an example. There is a city right on the North Carolina-Virginia border, and I can never remember which city it is. Eden, Danville, somewhere like that. There is a Miller bottling plant there, and I always like to use this as an example because this is a very recent thing. Miller bottling plant, and like 90% of the community worked at the Miller bottling plant. Well, folks, they shut it down. You know what that does to a local economy when one big company and 90% of the people who work there, have now lost their jobs, or 90% of people that live there lost their jobs. So let's say that they bought a house that was a booming economy for $400,000. They shut down that plant. You couldn't give that house away. So now they're trying to move away and find somewhere else to live. They did nothing wrong, but they couldn't sell it for the $400 they bought it for. So they may go to the bank and say, would you allow us to sell it for $300? Because we could probably find a buyer for that. So a short sale and a foreclosure are not the same thing. Sometimes they just happen to be going on in tandem due to certain very specific circumstances, but they're not the same. So a short sale is absolutely a material fact in North Carolina because, as I told you, it takes a very long time. So you would have to disclose to a buyer that you are trying to facilitate a short sale because it could be weeks, it could be months, it could be years before the banks would actually approve this sale to go through. There's also a lot of other things that come into play. I want you to think about it. We just talked about the offer to purchase and contract Form 2T in the last section, and I told you that there's no automatic assumption for repairs. If you use the 2T in North Carolina, homes are being sold in their then current condition, but you can negotiate in repairs potentially. Well, the sellers are walking away making negative money. They're not going to do any repairs, which is another reason why it's a short sale. They're not going to do anything. They're just trying to get out from under it. So a lot of different things make this a material fact, and it would absolutely need to be disclosed. On that same note, when we talked about the 2T and we talked about addenda, add-ons that could be put into it, one of them is the short sale addendum, which basically states everybody knows this is a short sale, and that even if the seller agrees to sell it, that the final approval has to come from the lender. And as I told you, the lender sometimes sits on it for a while before they make a decision on whether or not they'll approve it or not. So the other thing that adds complexity here, if you've got one lien holder, you only have to ask permission from one person. If you've got multiple lien holders, you would have to ask permission from all of them, because if there's not even enough money to pay lien holder one, that means lien holder one has to agree to take even less than normal, because there needs to be a little bit of money to go to lien holder two and lien holder three. Otherwise, they're not going to voluntarily agree to this. So this is all voluntary. You cannot force their hands. You have to ask permission. Now, If we were dealing with the banks and trying to negotiate, that would be the unauthorized practice of law. So all we can do is, help facilitate the transaction, explain to them what they need to do, let them know how it goes, disclose the material facts, and we could call the bank for updates. Have you accepted this or not yet? But we can't be calling the bank and negotiating on behalf of them. We're not attorneys, so we got to err on the side of caution with that. But that is a short sale, okay? Short on funds to satisfy or pay off all the liens or all the debt accompanied by the liens. So I had circled back around in the slides, and so you've actually already seen this next one. The other one, the other big, financing instrument, and you're going to be tested on both. There is the security instrument, which is where the home is basically being pledged as collateral, and it depends on the state. That's the title theory state is the deed of trust. Lien theory state is the mortgage. And then there's the promissory note. Now, folks, listen to me. The way that they always test this is that the promissory note is the evidence of the debt and the promise to pay it back. It's the evidence of the debt. The lien is the right to go after a property if you don't pay this. So one is the IOU, one is the security instrument that says they know a way to get their money if you don't pay them. So the promissory note is a form of contract. As such, it is in writing, can be recorded, but typically isn't, because you and the banks having a copy is enough. And because the liens are recorded, they feel protected even without recording the promissory note. Recording it would just inform the public, but the deed of trust is recorded. And so we talked about the clauses that are very commonly in these promissory notes, and you just told me one, the acceleration clause. That means we are speeding up the maturity. Yeah, you did have 30 years, but you messed up in some way, shape, or form, so now the total balance is due and payable immediately. The other one was a prepayment penalty clause, which is where you get penalized for paying it off early. Not allowed on government-backed loans. And then an alienation clause, also called a due on sale clause. So if you remove yourself from the ownership, which is what alienation means, you got to pay it off. This means that the loan is not assumable. Nobody can take over your loan and your payments. If you sell the house, you got to pay off the balance. They got to get a new loan. Yet again, not allowed on government-backed loans. FHA, VA, USDA. We're going to talk more about those in just a minute. So when we're dealing with these promissory notes, most of them are what we call a negotiable note or a negotiable instrument. And this is where I told you they basically put it in there that they can assign it to somebody else. Okay, so it means the note can be transferred or sold. And that's very commonly happens. They will fund it. They will become the originators. Some banks will continue to service it. Some will sell it off, make some more money up front, and then other banks will have a tendency to service it. If it was a non-negotiable note, that would mean that it's going to be serviced in-house forever and ever. Amen. It's only payable to that one named person. But most of them are negotiable, and they sell them off. Now, this other piece says some states use a bond in lieu of a promissory note. A bond is basically like a business insurance policy. It's basically somebody guaranteeing a certain amount to be paid if there was ever to be a default in your contractual agreements or something like that. But, that's not super consequential. So, give you one more second. We're taking notes, and then I'm going to ask you a couple questions, and we'll move on into some good stuff.
Steph, North Carolina never uses a bond in lieu, right?
Well, we don't use a bond for these notes, but don't confuse that with like the other time we use in lieu, which is a deed in lieu of foreclosure. But yeah, we don't use bonds in North Carolina.
Okay.
Correct. So here's a question for you. This clause gives a legal right to the lender to require full repayment of the loan once the borrower defaults.
Acceleration.
Acceleration clause. How about this one? This provision requires payment of the entire loan balance when the finance property is sold/transferred.
Alienation.
Alienation clause. There's a little alien for you. Alienation clause. Let's talk about this for a second. Here's where we get into some of the more interesting financing discussions. Folks, I told you the reason this section is so important is because the vast majority of people do not have hundreds and hundreds of thousands or millions of dollars in cash laying around. I'm not saying some don't. There are plenty that do. But most don't, and most people finance. Now, I do want you to understand that when we're dealing with selling the property, under most circumstances, we still call it a cash sale, even if you're getting a loan. Why? Because there is cash, folks. Think about it. It didn't come from the seller, or I'm sorry, the buyer, but there is cash. When the bank lends you $320,000, that's cash. When they put the $80,000 down payment, that's cash. And so sometimes when they refer to a closing as a cash sale, it just means it was all paid. So there's no like seller financing. There's no, things of that nature. Now, of course, there is the context of actually paying cash. So if you're paying cash, there's no loan. But even with a loan, sometimes it's referred to as a cash sale because it all was cash, just not all from the borrower. I don't think they're really going to throw that on any of the test questions too much. This is kind of one of those like frivolous things we have to tell you in kind of passing discussions on the financing. But ultimately, the questions will be more straightforward than trying to trick you about whether a cash sale was a cash sale or a cash sale. Now, there are different ways that we are not doing cash sales, meaning that, we're paying off the seller's full balance and conveying ownership, directly. And that is some of the more unique things. Well, there was the installment land contract that we talked about later. And so that loan, if there was one, wouldn't be paid off. There would be installment payments that may ultimately make it paid off. But aside from that, there is these concepts that we call subject to and a loan assumption. So I kept calling you the alienation clause. I said, well, then there's an alienation clause. That means your loan's not assumable. Well, if there's no alienation clause, you could assume somebody's loan if you met the right criteria. So let's say that I had a loan where my interest rate was 4.2% and I had 26 years left on it and my monthly payments were $1,700 a month. If it was an assumable loan, somebody could potentially talk to the banks, apply with that bank, and the bank may allow them to assume that loan. Now, that would not be a cash sale because that is involving a loan assumption. That loan was not paid off. Now, understand, though, a loan assumption is not an outright transaction because most people have equity in their homes. What is equity? Talked about that yesterday.
You owe less than what it's worth.
Yeah.
But the property is worth less your debt, right?
There you go. Yeah, y'all both nailed it. The difference between what you could sell it for and what you owe the banks, that's your equity. And so when you allow somebody to assume your loan, that doesn't account for equity. So even with loan assumptions, there's typically a secondary loan to pay out the seller's equity. So you would assume one loan and get a second loan and have to pay two mortgages technically. That's outside of the scope of this class, but understand that that's how loan assumptions typically work. Nobody's giving you their equity for free. Now, subject 2 is a little bit different because they're not transferring the actual loan to you. What they're basically doing is entering into an agreement where you will make payments to them and they will make payments to the lending company, or better yet, you will make the payments to their lender directly, but it's still in their name. And so, of course, the original owner maintains responsibility in the event of a default. Now, if you were to do this and try to transfer the ownership over by way of a quitclaim deed or something like that without the bank's permission, that would constitute loan fraud. Not a good idea. But basically, you're taking ownership subject to their existing mortgage, so they start paying it in their name, and the original person on the loan maintains liability. What you got, Jacob?
I don't know if this is relevant, but wouldn't this typically be how like a rent-to-own situation works, right?
The problem with the subject 2 is where they will typically transfer it, and it doesn't have to be that way. I mean, it could be either in theory. So you could potentially let somebody, rent it and with the intent to future own it, and so then it would be like a rent to own. In some of these scenarios, though, they will actually deed it over to the current owner, but they just the new buyer, and just have them continue to make the payments, and so that security agreement stays on there. But there's no set way that this has to be done. It could be done like a rent to own situation, depending on what they negotiate. Now, just like some of those other alternate commands contracts, this is not things that you could do without an attorney and or a lender, being aware of them, unless you want to mess it up and get in trouble. So it would just have to be outlined. Yeah. Let me ask you a question. True or false? After being foreclosed on by a lending institution, the lender has the right to file a deficiency judgment against the borrower.
True.
True.
True, under the circumstances that they didn't get all their money. If they sold it at auction for more than what they were owed and they got all of it, of course they wouldn't have the right to do it. But if they got less than what they were owed, they would absolutely have the right to file a deficiency judgment against the borrower if they so wanted to. Now, same thing is true of a short sale. Even though they may approve the short sale, that doesn't mean they forgive and forget, folks. So if they allow you to sell it for less than what you owe them, they could still file a deficiency judgment thereafter and go after you for that lesser amount or that amount they didn't get. Or same thing, they could actually do what they did the other time, forgive it, and then write it off on their taxes, and then it could be counted as income. So works very similarly. Now here's where we get into the different, we'll call them loan types. Now these are things that you have probably heard before, and these are things that you will continue to hear. So most of you have heard conventional loan at some point. A conventional loan is a private loan made directly between you and the bank. When I say private, it's between you and the bank. The lender bears all the risks. If you mess up, it's on the lender. Or it's on you and the lender. So this is a big differentiation between what we call government-backed loans. Government-backed loans are because of programs that help make home ownership more affordable. And so what they would do is they would help bear some of the risks of lending to people who may be considered sometimes riskier people to borrow. And they would help kind of ensure or guarantee certain protections for the banks. Conventional loans have no government backing. Now, they are very commonly a 20% down type of loan. The most common conventional is put a 20% down payment. Are there loan programs with conventional with less than 20% down? Absolutely. But here's the thing you have to know on the test, I promise. 20% down is a sweet spot where you are considered a much lower risk. And I'll tell you why. If we were dealing with, let me get my calculator out here and show you this. My search bar disappeared. I don't know what's happening here. There we go. Let's say you're buying a $400,000 house and you are putting a 20% down payment. That is $80,000. Folks, are you really super likely to walk away and abandon that house and forego almost $100,000 in equity if times get tough? No, that's a lot of money to have sitting there. So when you put 20% down, the banks consider you a much lower to moderate risk to lend to. And so what that means is they're not super worried, and so they do not require you to have what we call private mortgage insurance. If you put less than 20% down on a conventional loan, you are typically required to have private mortgage insurance. And here's why. There are programs with only 3% down for conventional. That's $12,000. Folks, if your mortgage payment is $2,500 a month, you let that house go real quick if you can't afford it anymore, because at the end of the day, $12,000 is less than what you would pay in a year to live there if you needed to go move and get somewhere cheaper. So you are much higher risk if you put less than 20% down. And so anytime that you're getting a conventional loan, which is a private loan where the lender bears all the risks, and you put less than 20% down payment, they make you purchase what we call private mortgage insurance. Now here's where I will remind you, and I said this earlier, there are multiple types of taxes, there are multiple types of insurance. Don't get them confused. Homeowners insurance protects your structure. Title insurance protects your concept of ownership. Mortgage insurance actually doesn't protect you at all. It protects the banks if you default. You have to pay for it. But what it basically helps cover is that spread of the 20% down payment that they wanted to get and the 3% you put down. It's basically an insurance company saying, okay, we'll cut you a check to make up that difference to minimize the loss if you have to foreclose upon them. Because you're a lot less likely to get the money that you needed to get from foreclosure to satisfy the debt. So it is an insurance policy to protect the lender because you are a high-risk borrower. Now, I keep calling it private mortgage insurance. Why? Because conventional loans are private loans. If we were dealing with a government-backed loan and their mortgage insurance, we just call it MI, mortgage insurance. It's not private, it's government subsidized. Now, this is where we've been utilizing the terminologies like loan-to-value ratio. So 80% LTV, that means you put 20% down, borrowed 80%. That's where you wouldn't need PMI. 95.5 LTV or 95 LTV, you would need PMI. 90% LTV, you would need PMI. So conventional loans are not government backed in any way, shape, and form. What that means is a conventional loan can have all of those different clauses we talked about. Conventional loan can have an acceleration clause. All loans can have an acceleration clause. Conventional loans can have a prepayment penalty clause. Conventional loans can have an alienation clause. Only the government-backed ones cannot have prepayment penalty clauses and alienation clauses. Conventional is not government-backed. Everybody okay so far? Now, it's not so much a conventional loan as you think about it for buying a house, but one of the other conversations that comes up here is different lines of credit or utilizing equity in different ways. They're not government-backed or protected. They typically fall into the same kind of lending criteria as conventional loans where the lender's bearing all the risks. And so, of course, a home equity line of credit is basically where you've got a credit card that is tied to your house's equity. So you can use it, delete it, replenish it, pay it back, and just keep, utilizing it on a, regular basis as a home equity line of credit. A home equity loan is basically one of two things. People do what's called a cash out refi, where the banks will give you money based on your equity, and then you just have a new loan altogether, and you will make a new payment. The problem with that is you typically start the clock over, as I said. There is also secondary liens where you can cash it out with a second lien holder, and so you would have your same first lien that you had to pay, but if you took out $100,000, you would have a second lien for that $100,000 home equity loan. But the loan is, once you pay it off, you're done. The home equity line of credit, you can pay it down and continue to use it, much like a credit card. Fall into the same or similar criteria as to conventional because the lender is bearing all the risks. And of course, if you were doing this and they were a second lien, they would be in a secondary priority versus the first lien holder because they were recorded second. However, there is something called a subordination agreement. A subordination agreement is where these lien holders could agree that even though this one should be the first one, that they would allow this one to sit above them. Maybe if it's the same lending institution or for another reason, they could basically change the priority utilizing a subordination agreement. I am going to subordinate my right to yours. Don't get so caught up as to why they would do that. It's typically because they're the same bank and they want one paid before the other. So we've already done a little bit of the math for the loan to value ratios and I've explained it, but just here's a visual for it. Okay. If we said that we were getting a 90% loan to value ratio, well, LTV, I told you, is the percentage you are borrowing based on the purchase price or the appraised value, whichever is lower. So if the house has no appraisal issues, you will get that percentage of the purchase price. However, if it appraises for less than what you agreed to purchase it at, they will only give you that percentage of the appraised value, which could mean that you have to bring even more to closing if you still want to buy that house. More of a down payment. Now, this is just trying to reverse engineer the problem, folks, and I'll show you why this works. So that algebra thing y'all don't like. If we had purchase price of $100,000 and I told you that we were getting a 90% loan to value ratio, you would know that you would just multiply by 90% to figure out that the loan amount is $90,000. Well, in this scenario, we told you what the loan amount was. We told you what the purchase price or the appraised value was. And so what they're asking you to find is, well, what is the loan to value ratio? Well, folks, that means you don't have this. What is the rate? Divide by 100,000 on this side. Divide by 100,000 on this side. That's all you just did. If we're ever trying to find the rate, you just move it all over. So $90,000 loan amount divided by the $100,000 purchase price will tell you what your loan to value ratio was. 90,000 divided by 100,000. 0.9, 90% loan to value ratio. This is where those T-bars could come into play too, but all it is just, as I told you, a visual representation of when to multiply, when to divide, based on linear equations if you're not comfortable with them. Now, in this instance, because it is a 90% loan to value ratio, if this was a conventional loan, you would require private mortgage insurance, and you pay an annual premium at closing, just like you would for homeowners insurance, and then you would make monthly payments into an escrow account to pay your monthly dues for your mortgage insurance. That would be included in your PITI payment. That taxes and insurance. Default, it includes real property taxes and homeowners insurance. But if you have mortgage insurance, it gets lumped into there as well. And I told you that insurance is really trying to protect the banks from that spread of what they got, 10% down, versus what they really wanted, 20% down. So it's not a full coverage policy. It's not like they're going to get a check for $100,000 if you default. They're probably going to get one for, $10,000 in this scenario. So now let's switch gears and talk about the government-backed loans. Government-backed loans. FHA, VA, and USDA. Well, let's start with FHA. Now, folks, FHA stands for the Federal Housing Administration. The Federal Housing Administration. Why is that important? Because later we will talk about the Fair Housing Act. Do not confuse them. Federal Housing Administration deals with loans. The other one deals with discrimination. So FHA insured. Now, there's that key word insured. What happens here is The banks are the ones, this is very testable, the banks are still the ones lending you money in an FHA insured loan. But the Federal Housing Administration basically provides a government subsidized insurance pool. So you are buying your insurance through the FHA, the Federal Housing Administration. So it's not private mortgage insurance, it's government backed insurance. So, but they're not the ones lending you the money. The banks are still lending it. The loan has to meet what we call FHA underwriting guidelines to ensure that they meet the criteria as outlined by the government. And then this is great for buyers because it only requires down payments as low as 3.5%. And as you just saw, that is way more affordable versus $80,000. It'd only be like $12,500 or something like that. So if you get an FHA loan, there are certain criteria. Of course, you can't make over a certain amount of money. Have to have minimum credit scores to get this program. The mortgage insurance premium is just called mortgage insurance, MI versus PMI, because it's not private. But be aware, I'm going to say this again, the Federal Housing Administration is not the one lending the money. They're just basically, putting their arm around the bank and saying, we're here with you, helping subsidize that insurance policy. Now, I want to bring up another important point here to differentiate between the two. In a conventional loan, I'm going to go back for a second, okay? In a conventional loan, if you were to put 10% down, you're going to have to pay PMI. But let's say after a couple of years, the value of your house goes way up. And now, based on the value and your equity, the bank says, well, it's like you have 40% equity in your property. Well, 20% is a sweet spot for them to have because think about it. When you get your house, the day that you close, your down payment and your equity, in theory, are the same. If your house was to appraise for exactly what you bought it for, your down payment and your equity are the exact same in theory. So if you are in a conventional loan and you now have over 20% equity, all you have to do is call them and they will drop your PMI off. It'll fall off. Now, sometimes they require a new appraisal. Sometimes they don't, but it can fall off. That is very different than an FHA loan, folks. It doesn't matter if you have 80% equity at some point with an FHA loan. It will never fall off. Your mortgage insurance will be paid until the day you die, or until the day you pay it off, or until you refinance with a conventional loan. So mortgage insurance premiums do not fall off on government-backed loans. You would have to refinance and get out of a government-backed loan for it to fall off. Have you ever heard anybody talk ill towards an FHA loan? It would probably be a seller. Sellers don't like government-backed loans. Why? Because the government has some skin in the game. They're more strict with the appraisals and the guidelines. So they have to use certified or qualified appraisers that are approved by the FHA. They have to meet certain criteria. And they're bordering on a home inspector. They're not just looking for, yep, there's a house, yep, it's standing. They are looking for different features. Is there any damage? Is there anything unsafe? Is there anything that would, destroy the value? Is there any rotted siding? And if there's anything that they don't like, they could say, well, we're not going to fund this unless you fix it. And if the seller doesn't want to fix it, you may not get the loan. So these are not really great under most circumstances to be utilized for distressed properties. Now, there is a very specific product they have for a property that is needing to be rehabbed or a renovation product. But the standard one that the homeowners would utilize, they need the home to be in good condition. So that's what that last one says, construction minimum standards. So just like the money is not lent by the Federal Housing Administration, it's lent by the banks, the interest rates are not set by the FHA, the Federal Housing Administration. They're set by the lenders. They're set by the market. They're set by the normal, ways that any others are. And these are also designed for owner occupancy, not designed for investment properties. Okay, told you there's some for renovation, but that's for ultimate owner occupancy. So if you were to utilize an FHA loan to buy a house and then you turn around and rented that house out as an investment, that is called loan fraud. Loan fraud is punishable with fines up to $1 million and up to 30 years in prison. Now, I don't know about you, but I don't look at an orange. And listen, I'm kind of a snuggly man. I might become somebody's boyfriend real quick, okay? I don't need that kind of negativity in my life. I'm going to stay out of the po-po, or the jail, the pokey.
So, Seth, I have a question.
What you got?
Yeah, so if I buy a house, FHA loan, like a new construction house, then I use that. Initially, I use the FHA loan for my personal, residence. Then after, down the road, I use that for like full rental property. So I cannot use that. That's what you mean.
Excellent question. So Manoj's question is, what if I buy it as an owner-occupied home with an FHA loan, but after a period of time, turn it into a rental? It's okay. They typically have time frame guidelines. They'll basically say something like, as long as you've lived here a year, as long as you've lived here for 90 days, as long as you've lived here for 2 years. I couldn't tell you the time frame, but there is a time frame that as long as you've lived there for that period of time, it is okay to turn it into a rental after that period of time. But it's not okay to do it immediately when you buy it. So you would have to look at your promissory note to see what your time frame was in that regard if you had one, or call the bank. But it is possible after a certain period of time has transpired, and it would be not a problem.
Okay, thanks.
Mm-hmm. FHA loans, I told you, government-backed loans, because of that, they are always assumable. That means they lack that alienation clause. They cannot have it in there. They lack that prepayment penalty clause for the same reason. Of course, lead-based paint disclosures would be required for the funding. The government needs to see certain things. I told you it's for owner occupancy, okay? So this is an FHA loan. This is for anyone as long as you meet the criteria, you have the credit score, you don't make too much money. If you were to compare them side by side, though, like if a seller had a conventional loan offer and an FHA loan offer, because of those additional restrictions, most sellers are going to go with the conventional over any of the other loans, hands down. So just a few moments ago, let me see if you can remember, I told you how you would utilize the information in the loan to value ratio to help you determine, if I gave you the loan amount and the purchase price, what the loan to value ratio is. So what did I tell you? How would you calculate the loan to value ratio based on that given information?
I wrote it down as loan amount divided by appraisal equals the LTV.
Beautiful. Appraisal or sales price. There you go. Because remember, it is based on the sales price or the appraisal, whichever is lower. So loan amount divided by sales price or appraised value equals your LTV. So the next one in the government list you've heard of as well. It's called a VA loan. Okay. VA is the Department of Veteran Affairs. These loans are for military, active duty, retired, honorably discharged, spouses of widowed military, things of that nature. If you are not military or you don't have any direct tie-in like that, you cannot, will not, and won't not get this loan. They will not give it to you. And if you were dishonorably discharged, you cannot get this either. So these are fantastic loan products for our military and vets, because these, where the FHA had very high loan-to-value ratios of like 96.5%, this one has 100%. These are exceptionally high loan-to-value ratios. They will allow you to borrow all the money. You don't even have to put a down payment on for a VA loan. Now, notice the change in words here. FHA was insured, VA was guaranteed. That's because the Department of Veteran Affairs is basically acting as the insurance company. There is no third-party insurance company. They basically say, we'll cut you the check for the difference between what you would have liked to have gotten as a down payment and what you didn't. So in other words, about 20% of the purchase price. They are willing to cut a check for that. And now it is also based on what we call your entitlement. So VA loans, folks, understand, people get confused about this. This is not the government saying, go buy a house, you're good. You still have to make the money to qualify to buy the house. So it's not like you can go out, making $7.25 an hour and buy a $6 million house with a VA loan. No. It's if you qualify to buy a house, we will make sure that the banks will lend you 100% of the value because we are willing to cut a check for the 20% difference if you default to make the banks feel better. That is that guarantee. It's always about covering that spread between the 20% the banks would like to see and what they actually got. In this case, they get zero. And so the Department of Veteran Affairs is willing to cut that check if you default. Now, understand if you default, you lose your eligibility. They said, well, we gave you one, okay? You tried, you screwed up, and you can't get a VA loan anymore.
There's a lot of restrictions on VA loans.
There's a lot of restrictions on VA loans. Now, this is also, if you remember earlier when we talked about the agency agreements, where we stated that, on a buyer agency agreement, we say, okay, well, we're going to look to get paid by the seller or the listing firm first. But if they are not willing to pay us, then we're going to look for the buyer to potentially pay us. And remember, the VA loans, they can't. VA prohibits the VA borrower from paying the commission to their buyer's agent. And there's a lot of restrictions on the homes. There's a lot of restrictions on age. There's a lot of restrictions on, what they'll lend on, what they won't. A lot of restrictions. What you got, Jacob?
So on the midterm, there was a question saying what would be considered red flags as a real estate agent, and one of the options was a VA loan. And I don't remember what I answered, and I don't remember if I got it right, to be honest. But I was wondering, is that considered a red flag because of all of its limitations, or no?
So that's a tough one, because I would have to say it would depend on the context of the question. Is a VA loan a red flag in and of itself? Absolutely not. It's a loan type, and it just has to work a certain way. If I was a listing agent and my job was to make sure that my seller made the most money without the most responsibility, would the VA be a red flag in that regard if they had a cash offer for the same price? Yeah. So I would need a little more context of the question, but I wouldn't call a VA loan a red flag. It is a perfectly functional and fantastic loan product, but of course, if tit for tat, it's not as good as a conventional loan to a seller because of the restrictions that might be imposed on the seller. What you got, Adriana?
I'm not sure if I missed that. This VA loan, when you say that owner occupied, is just for a certain period or forever?
Same thing as the FHA. When you get this loan and you initially apply for it, you are applying to buy a house to live in. Now, much like the FHA, there are time criteria. So as long as you live there for a certain period of time, they will allow you to turn it into a rental. But I don't know what the period of time is, but it's like a year or something like that. As long as you've occupied it for a year, you can turn it into a rental. You just can't buy it with the intention of utilizing it for a rental.
Okay,
yeah.
Thank you.
Now, I don't think this is going to show up on your test, but unlike the FHA, there are rare times that the VA will actually lend the money. For somebody who's in an area where there not be a lending institution available, rare instances, they may actually lend money to their veterans directly. Typically, they don't, though. It's the same thing. The money's typically coming from the bank, and they are just guaranteeing it. And then it also says does not build homes. They don't build homes, but they do have new construction loans that you can utilize for VA. Is that the question, Sam? All of the following are considered red flag situations for a real estate broker in North Carolina, except, and the answer was D, the buyer who wants to purchase with financing a VA loan. Another option was something about buyer wanting chickens in the backyard. So it was saying that the VA buyer was not a red flag, which is fine. Yeah, I mean, it's really not. For advice to a seller, is it as good as some of the other offers? No. But is it a red flag? No.
How are chickens a red flag?
Because we would need to.
Where HOA is, you can't have chickens, or it depends.
There you go. We would need to inquire as to whether or not they could have them. That would be something that could be a consideration as a red flag. If they, needed a place with chickens, wanted to be a place without them, that could be something that changes their ability to live there. And we may want to advise them on that. Because if they say, I need a place for chickens, and we let them buy it without looking into it, we could be in trouble because then we let them buy something that was not suitable for their needs.
Yeah, because I ain't never living anywhere where I can't have animals.
There you go. I ain't never living anywhere I can't have my chickens, okay? Juan Pablo.
Goats, dogs, and cats. No.
My chicken Juan Pablo. Henrietta. Clacky.
No, my chickens aren't named. Everything else is named.
Why are you not going to name your chickens? That's just cold-blooded.
Because my son wanted to name them stupid names, and I won't.
Sounds like a good idea. It's a stupid bird. Give him a stupid name. Culling. Anyway. So a couple other things that we need to talk about with the VA loans. So VA loans, Department of Veteran Affairs. Now, folks, the thing is, VA loans, even though you only can get them as a veteran, because they're government-backed loans, they are assumable loans. Folks, they are assumable by anyone. They just have to meet the financial criteria. You do not have to be a veteran to assume it, but here's the problem. If you are a veteran who purchased a house with a VA loan, and then you let somebody assume your loan to take over this house, your VA entitlement is still tied to that house. That means if they default, you lose your entitlement through no wrongdoing. So it is not a good idea for somebody with a VA loan to allow a non-veteran to assume it, because that would tie up their entitlement and it could cause them to lose it. Now I'll give you a little more insight, but I owe you a break. Come back at 7:25. Whoop, whoop. So we are talking about lending, loans more specifically. We're getting into the government-backed loans. And so we talked about conventional. Talked about FHA, which is the Federal Housing Administration. Now we're talking about VA, which is the Department of Veteran Affairs. And so you get the entitlement to have this type of loan based on your service, years of service, the way that you left, all those different things. Now, there's no prepayment penalty. There's no alienation clause because it's a government-backed loan. Because the government has some skin in the game, there are more strict appraisal criteria for this as well, just like an FHA loan. And then, of course, when we're dealing with this, you would have to utilize the certificate of eligibility to determine the portion of the loan that the VA is willing to guarantee based on your entitlement for those years of service. Now, I told you that while you can let anybody assume your VA loan, if it was a non-veteran assuming it and they defaulted, they could destroy your entitlement and you would not get it back. And the other thing to be aware of is that no, you cannot buy a house just because you're a VA purchaser. You still have to qualify for the loan. So let's say that you've been in the military for 30 years and they are willing to guarantee a very large portion of money for you. If you're not making any money, you're not buying a house because you have to meet the criteria to be lended money, and then your service determines your eligibility for this guarantee. And of course, you can use this as many times as long as you never default. So when you sell, your entitlement's restored, you can buy again. I've got a husband and wife couple that I've helped with multiple homes, and they've got several simultaneously because they have so much entitlement between the two that I think at one point they had 3 homes through VA loans because they qualified to buy them, and they had so much entitlement. So just like before, the individual lending institutions lend the money under most circumstances, and they also are the ones setting the rates, not the Department of Veteran Affairs. Now in North Carolina, for the FHA and the VA loan, I don't know if this one is going to come up at all on your test, but for the FHA and the VA loan, there is an addendum called the FHA VA Financing Addendum that I briefly mentioned, where if you are utilizing one of these loans, it basically states that if the property doesn't appraise for what you said you were going to buy it for, you have the right to back out and not forfeit your earnest money only, is what it specifically states. And so what's referenced on that VA FHA financing addendum under the VA portion is the CRV that you see on the slides here, the Certificate of Reasonable Value, which is basically where they do their appraiser and they say this is what we think it's worth, and of course if it matches with what you're trying to pay for it, they will give you up to 100% of that amount. But if it appraises for less, you could still elect to move forward with it, but you're going to have to pay some money out of pocket at that point because they will only give you 100% loan to value ratio, which is 100% of the purchase price or 100% of the appraised value, whichever is lower. So now we're about to get into a couple other things. Now I'm going to mention it because I don't remember exactly how in depth it goes into the slides. But let me just go ahead and drop in the other government-backed loan because it tends to get breezed over and it's not nearly as testable. So we've got the FHA, the VA, and the USDA. Yes, the same USDA you see on steaks. It is the U.S. Department of Agriculture. So USDA loans would be in rural areas with lower populations, maybe slightly lower incomes. The whole point is to allow less populated areas to grow. Think about it from a municipality point of view. The more homeowners, the more taxpayers. The more taxpayers, the more growth. The more growth, the more development. The more development, the more taxpayers. So it's basically a way of enticing borrowers to move into an area that may be a little more rural in general. And just like the VA loan, they are 100% loan to value ratio loans. Now there are income requirements, meaning you can't make too much money. You have to have certain credit score requirements. And the only way to know if something qualifies for a USDA loan is to actually look at a map. There are drawn maps that says this area can qualify for a USDA loan, this area cannot. But it is a government-backed loan as well, U.S. Department of Agriculture. I think there's one more note on the VAs before I switch to further things, and I can't remember if there is a USDA slide or not, which is why I just went ahead and threw it in there. But the VA loans being assumable, of course, it says VA release of liability does not release the borrower from liability to the lender. Basically means you would sit in a secondary position of liability unless you were to get a full release signed in the instance of somebody assuming your loan. And of course, that's where you would lose your entitlement if you were still tied into it. Your entitlement is still tied into it. It's not a good idea. So while you can let somebody assume it, probably not a good idea. Let's see if there's a USDA slide. 1, 2, yeah. Can never remember if there's a USDA slide or not. So here you go. The USDA, U.S. Department of Agriculture. For low to moderate income families in rural areas, guaranteed or direct loans available, 100% financing, all there is to it. So these are all the government-backed loans. FHA, VA, USDA.
So I was glad to see that on the slide of longer than normal repayment periods become longer than 30 years. And I did several of these back in the day, and I found them to be really good loans for certain groups of people.
Yeah, they're fantastic loans to get into, buying real estate if you can find something in that area. Make it home ownership very affordable, and especially if you buy the right deal and things have a tendency to appreciate, it can be a very great loan. So let me ask you a question or so. in regard to some of these loan conversations. True or false? Conventional loans are insured by federal agencies such as the Fair Housing Administration or the Veterans Administration.
False.
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 Conventional loans are private loans. The lender bears all the risk. Now, I keep talking about these government-backed loans, and we just talked about them. These government-backed loans are required to conform to HUD standards. HUD is the Department of Housing and Urban Development. Of course, they have some oversight into all this. And then I also told you that the lenders, while the lenders are the ones lending money, they have to be meeting what we call underwriting guidelines. You've heard underwriting before. It's basically a set, think of it like a recipe. FHA, VA, and USDA give them a recipe. They said, if you make this, we will buy it. All right, that's basically what it is, or we will guarantee it or insure it. And that same thing is going to be true when we get into the secondary mortgage market. It has to meet certain underwriting guidelines for these certain types of loans to go into this secondary mortgage market. And I'll explain that more in a moment. But it has to meet the standards as outlined by the government practices. So here's where I will formally introduce the kind of unique seller financing aspect. And this is where I told you I didn't want you to get them confused. Recently, we talked about the installment land contract called the contract for deed, land sales contract, a lot of different names for it. What did I tell you was the most testable piece about the installment land contract?
That it was owner financing?
No, that wasn't the most testable piece, and that's where I told you to be careful to not necessarily call it true seller financing because of the way that it's installment payments. It doesn't act like true seller financing, so I want you to differentiate it between what we're about to talk about. What was the most testable piece of that?
If the buyer defaults, they can lose all their money and the buyer can't sell it to anyone else.
Important, but not the most testable piece. What does the seller have? What does the buyer have?
The buyer holds the equitable.
Buyer is said to hold equitable title. They are working towards owning it and they are treating it like their own, but they do not own it. And what does the seller hold?
The legal title.
Legal title.
Legal title. And when would the seller transfer legal title to the buyer in an installment land contract?
When the final payment's made.
When the final payment is made. Here's why I needed to make this point. This next thing is called a purchase money mortgage. It is what I would like to call true seller financing. It is where the seller acts like the bank. So in the other one, they were basically making installment payments and they would eventually legally own it. In this one, the seller actually acts like the bank. Now, before I even go into that, let's just talk about the word purchase money mortgage. In other words, the seller is going to give you the purchase money and they're going to take back a mortgage. Just like the banks give you the purchase money and take back a mortgage or a deed of trust in their respective states. Same thing here. So what the seller will do, here's the big difference, will actually deliver legal title to the buyer at closing and then take back a note and a deed of trust against the property just like the banks do. Yes, you hold legal title, but we have the right to go after it if you default and foreclose upon you just like a bank. It's called a purchase money mortgage. If you see that terminology on the test, it is that seller financing piece. Key difference is buyer gets legal title at closing, the seller takes back a note. And the other one, seller retained legal title, buyer only had equitable title. So huge difference between an installment land contract and a purchase money mortgage. Everybody okay with those statements? This one should be thought of as true seller financing. The other one is more adequately like a rent to own. Now here's where we get into one concept we've already talked about, just a little more in depth, and then we're going to get into a lot of flashcard level stuff in the financing chapter. Flashcard is good, right? Just recall what it is. A lot of this stuff is a little analytical, but then the next things after this upcoming stuff is more of just flashcard level. So before I flip the slide, I'm going to go more in depth. Let me see what you remember from yesterday. I was talking about a pity payment, and of course within that, PI is principal and interest. What's the other name for the paying back of principal and interest? What did I call that?
Debt service.
Debt service. Debt service is quite literally the repayment of your principal and interest balance. And what did we call the paying back of the loan? There was a fancy word for it.
Amortization.
There you go. Amortization. Amortization. Here's where I'm going to just talk about that a little bit more, okay? Most people, when they borrow money to buy a house, get what's called a fixed rate, fully amortized loan, or a fully amortized fixed rate loan. So that means that your interest rate is fixed. It's not going to change. On the days that you get it, it's 4%. 360 payments later, it's still at 4%. So that's what the fixed rate piece is. Fully amortized means, as I told you yesterday, if you make every principal and interest payment on time for the exact penny that they want you to make it, when you make your last structured payment, you have reduced your balance to zero.
Zero.
There you go. Fully amortized means you have paid it off. That is what most of us do. Now, there is what we call a partially amortized loan. And that's where I told you you might borrow $200,000, have a 10-year repayment schedule, and after those 10 years have transpired, you still have a $100,000 balance. And what you're going to do with that is just make a lump sum payment of $100,000. We call that a balloon payment. Now, folks, yet again, just like the estate section, just because it doesn't make sense to you doesn't mean that it doesn't make sense. There are plenty of people who buy properties who intend to have a chunk of change after doing something, and so they just plan to pay off a lump sum at the end. So they would utilize a partially amortized loan, or they might even utilize this interest-only loan, also sometimes called a term or straight loan. So this is where whatever your payment structure is, your monthly payments are only enough to cover the interest. So that means, let's say that you borrowed $100,000 and you promised to pay it back in 3 years. You made monthly payments of some amount, but those payments only went towards the interest you owe the bank. So 3 years from now, you still owe $100,000. That is called an interest-only loan, also sometimes called a term or straight loan. And so you're only paying enough each month to cover the interest, and then you will make a big lump payment, yet again, still called a balloon payment, at the end. Now, most of us aren't going to do this. You know who does love to do this? Developers. Because they buy property for millions of dollars. It takes them 3 years to develop it to make their money. So they want to keep their carrying costs down as low as possible. And so when they borrow $3 million, they make payments maybe in total of, $1.5 million over these 3 years. So they've paid $1.5 million. They still owe $3 million. But when they sell all these lots to a builder, they make $20 million. So now they're just going to pay off that $3 million, repay themselves for the carrying cost of $1.5 million, and walk away with their, 15 and some change $1 million. So yet again, just because it doesn't make sense to you doesn't mean it doesn't make sense. There are plenty of people who anticipate to have a fat stack of money to pay off that lump sum, and so they want to keep their carrying costs down while they're trying to make that fat stack of money. Everybody with me? So fully amortized means your balance will be zero when you make your last payment. Partially amortized means your balance will go down, but it won't be zero and you'll have a balloon payment. And then interest only, also called a straight or term loan. All your payments go straight to interest. So your balance on day one, your balance when you're paying it off are the same, and you're going to pay it off with a balloon payment, that lump sum. Well, the first one I told you is the most common one for buying houses. Fixed rate, fully amortized loan. Well, there's also this other thing that I'm sure you've heard about called an adjustable rate mortgage. It's called an ARM. And they're making a comeback. Why? Because interest rates are so high anyway, and so sometimes banks will offer an adjustable rate mortgage with what we call a teaser rate. A lower amount up front. So let's say that the going rate right now is 6.7. They may say, well, hey, we'll give you an adjustable rate mortgage, but we'll give you the first year at 5.2. Then it'll go up to 5.9, and then it'll go up, who knows? So they could set it where it's static for, it changes every year. They could set it where it changes every 3 years. And so that would be identified in it. It could be a 2-year ARM where it changes every 2 years, and 1-year ARM where it changes every year. It could be a 5-year. They also have products that are basically locked in for 5 years but become adjustable after that period of time. This would all be identified. But of course, if you think about it, if you were going to definitely refinance, and you've got a locked-in rate for 3 years, and you think you're going to lock it, refinance within 3 years of buying your house, it might be good to do that because then you're getting like a 5.9 versus the 6.9 for those 3 years, and before it goes up, maybe the interest rates came down and you refinance. The problem with adjustable rate mortgages, though, is sometimes there are rate caps, which limits the amount that your rate can go up or down, which is great. But sometimes there are also payment caps. So what that means is, let's say that your interest rate goes up, but you have a payment cap. And so with your interest rate climbing, you should be paying $2,200 a month. But your payment cap is $1,800 a month. So you're only going to have to make an $1,800 a month payment. What that means is you're not even paying enough to pay off the interest. So this is when you get into a very dangerous situation called negative amortization. Your payments are less than the interest because your rate went up, but you had a payment cap. And so you're making your monthly payments on time, but they're just tacking on interest to your principal balance, your principal balance, your principal balance. So you did owe $200,000, but now because of this situation, next year you owe $220,000 because your payments weren't enough to pay off all of your interest plus your principal balance. It's called negative amortization. It is very dangerous. So you got to be very careful with these adjustable rate mortgages. Yeah, Misty says, I remember these from the 2008 fallout. Yeah, you know what was notorious back then, Misty? There was a program called Pick Your Payment. So you literally told the banks how much you wanted to pay. And sometimes people would pick an amount less than what was even their interest. And the banks are like, great. Just keep tacking it on there. I know, Stephanie. I know. That's what they do.
They weren't math majors.
No, not the people taking advantage of those. Absolutely not. And here's the thing. Go ahead.
They were really awful times.
Yeah.
The 2008, 2009, 2010, that stuff was really tough.
Yeah, yeah, absolutely. And we're going to find out here in a little bit, that's where a lot of big financial legislation reform came into play. The housing market crisis of 2008, 2009 led to the creation or the passing of a legislation called the Dodd-Frank Act. And then that led to the creation of the CFPB and actually going into some things a little bit more. So we're going to talk about that in a moment. What you got, Sandeep?
So when you say there's adjustable rate, is there a cap where it stops adjusting?
Typically, the cap is how much it can adjust per year. In theory, there could be a cap. It just depends on what you and the banks agree to. Of course, it would obviously have to fall within line of those usury laws, the limit set by law. They couldn't go higher than the limit set by law. But most of the time, the cap is just based on a maximum amount per climb period. So, in other words, it will never go up more than 0.5% per adjustment period. That's typically what the caps are doing.
And do you also have to have that payment cap that you were talking
You
about?
do not have to have the payment cap. That's just something that's part of some of them. So some of them are not limited, and your payment will just go up to with whatever your interest rate goes up to.
Cool. Thank you.
Yeah, and of course understand too, believe it or not, your interest rate can go down because it is based on the consumer price index. And so if things go down, your adjustable rate mortgage can go down. Does it typically? No, but can it? Sure. So, adjustable rate mortgage, it's just how you repay it. Your rate can adjust. Of course, that means your principal and interest payment can and will change with an adjustable rate mortgage. With a fixed rate, your principal interest payment is always the same. With this one, it could change. What you got, Adriana?
So if you start with this ARM at a certain point, because that's how you can afford. At a certain point, can you change the form of repayment?
Yeah, that's good.
Like a refinance?
Yes. Yes, you can. Yeah. The only thing you want to just make sure of is that there's no prepayment penalties for refinancing prior to the 30 years, which typically they don't have those. And so, that'd be an advantageous thing to do. You borrow $300,000 and it's locked in at, 5.7 for 3 years. And then at 3 years, it can go up, and it's set to go up to like a 6.4. But in that meantime, the average interest rates you could probably get for like 4.2. It would be very much in your best interest to refinance, get a new lender at the 4.2, pay this one off so it's gone, and then you would just have a new 30-year note with a new lender at 4.2 or whatever it is. So absolutely, you could refinance, and that's why this could be very advantageous for short-term ownership. If you plan on never refinancing, this is probably not a good idea. But if you plan on living there only for a couple of years and then selling or refinancing after a couple of years because you think rates are going to go down, you could get that teaser rate, teaser rate, which kind of locks you in at a lower rate than the market average right now.
So it starts the 30 years again.
Anytime you refinance, unless you specifically ask for a shorter loan term, you can ask the banks for whatever you want. 10, 15, 20, and 30 are the most typical, 30 being the most popular because it makes home ownership the most affordable. But you could easily go back and say, well, I want to do a 25-year this time. And they could amortize it out. It just changes the calculations. Most people don't realize that because 30 years is more affordable. But if you don't ask them to shorten it, they will just give you the 30-year again, and that restarts the clock.
Okay, thank you.
Absolutely. What you got, Jacob?
Are there any loans that you're not allowed to refinance?
Yeah. Well, there's no loans that you're not allowed to refinance, but there are loans that you could potentially have penalties for refinancing because that means you paid it off early. And so the prepayment penalty clause being in one would cause you to have to pay some penalties. It's not the full interest ever. That would be unlawful, but it would be some type of punishment for paying it off early. But there's none that you can't get out of. So, true or false? In a purchase money mortgage, buyer receives equitable title at closing and the deed once the debt is fully satisfied.
False.
False.
It is false.
It is false. Folks, I've been trying to warn you about this. In a purchase money mortgage, the buyer gets legal title at closing and the seller takes back a deed of trust and a promissory note against the property. In an installment land contract, the seller retains legal title and the buyer only gets equitable title until the last payment is made.
That's what I was kind of thinking, but everybody kept saying true.
I know. I'm just sitting here and I'm just like twitching a little bit. What you got, Monica?
I'm sorry, could you just repeat the logic again?
Yeah. So in this section, we just talked about the purchase money mortgage. Now, I equated it, or I compared and contrasted it to the installment land contract we spoke of previously. Remember, purchase money mortgage, the seller is giving you purchase money and they're taking back a mortgage, just like a bank. And so what happens at closing is the seller actually conveys the legal ownership by way of a deed to the buyer. So the buyer gets legal title at closing. And then the seller will record a lien against the property. The promissory note is outlined, and then they will record a deed of trust against the property, just like the banks would. So this isn't true because it says the buyer receives equitable title at closing in a purchase money mortgage. No, they get legal title at closing in a purchase money mortgage.
And who gets equitable title, just real quick?
There is no equitable title in this one because this one, they've got legal title. It's just that
No, I mean in general, equitable title is for what?
Equitable title is what the buyer gets in an installment land contract.
Installment land.
Installment land contract, also called a contract for deed, land sales contract, all of those different names that we talked about a couple days ago. Yeah. And so they wouldn't get legal title in an installment land contract until they made the last installment payment. So that, hands down, folks, the most testable installment land contract, knowing that buyer gets equitable title, seller retains legal title until it's paid off. Purchase money mortgage, buyer gets legal title, seller takes back a promissory note and a deed of trust against the property. Acts like the bank. Most testable parts of these. And that's why I don't like you to call for the installment land contract seller financing, because you're more likely to get it confused. This is the seller financing. The other one is the layaway program from Target, okay? Or Kmart. That's why it went under, because it had the layaway program. That's why they ain't no Kmarts anymore. Nobody finished paying the layaways. Boop, boop, doop. So here is the formal answer. This is false. This happens with installment land contracts. And the purchase money mortgage, the buyer receives the deed at closing. Whoop, whoop. So, we're not done with financing. This is just kind of a break in the financing discussions to kind of separate the principles versus practices side of things. And of course, some of it we'll circle back around to. What is an acceleration clause?
When you mess up and the bank says that you need to pay it back now.
Facts.
When you default on it and you have to pay it back now.
Yep. Some type of default, you messed up. It doesn't necessarily have to be you didn't pay your loan. There's a lot of things that could trigger that. So it's you had 30 years, you had 20 years, but pay it back now. Loan origination fee, that is the fee that the banks charge you for originating the loan. How would it appear on a closing disclosure?
To debit to the buyer.
Beautiful. Single entry buyer debit. There you go. Deed of trust is a security instrument utilized in which type of state?
Deed of trust.
Deed of trust.
Well, it's title theory.
Title theory. There you go. Deed of trust.
North Carolina.
Wait on which North Carolina is. There we go. Let's piece it all together. The deed of trust is the security instrument utilized in title theory states which North Carolina is. There are three parties: the grantor, the trustee, and the beneficiary. Okay, three parties. Discount points. Discount points increase the lender's what?
Yield.
Yield. And decrease the borrower's what?
Interest.
Interest rate. There you go. It is prepaid interest. You pay up front. Here's a sack of cash, Mr. and Mrs. Bank, to buy down my interest rate. That's discount points. One discount point costs how much?
1%.
1% of?
Loan amount.
Loan amount. Beautiful. And how much does it reduce your interest rate?
1/8.
1/8 of a percent, or in other words, 0.125. There you go. Oh, now I'm getting excited. Y'all are on it. How about hypothecation? What does that mean?
promise.
It's a promise, but it's also, it's the act of...
It's a guarantee?
Trying to give you a hint here. I'm not having a heart attack. Pledging. It's the act of pledging the home as collateral for the debt. That is hypothecation. Back in the day, Jacob, we used to do the Pledge of Allegiance in school, but then we got woke and we don't do it anymore. So we probably didn't do it when you were in kindergarten back in 2022 or whatever. So, no,
Kindergarten in 2022 is crazy.
I'm kidding. Right of redemption is the right to regain your the property in the midst of the foreclosure hearing. In North Carolina, we have a 10-day upset bid period when it goes to a foreclosure auction. Any upset bid would reset that 10-day period. You can come in and pay the full balance at any time within that 10 days, and you can stop the foreclosure. Short sale, short on funds to satisfy all liens. Absolutely a material fact. Have to get permission from the banks to do it. Not always something that does happen. So, we didn't just end the financing. I told you there's two different sides, practice and principles. So we're still talking about financing. I just kind of like put a little break in it so we can kind of change gears. Now here's where it's flashcard, okay? Everything that I'm about to tell you over the next few slides, flashcard financing stuff. Flashcard financing stuff. What you got, Misty?
Hi, so I'm in my book and I'm trying to make this note because I see under purchase money mortgage where they will hold a legal title, but under installment land contracts, I don't see where they hold equitable title. And is that correct? It's equitable title that I'm going to put a note in here?
The buyer is said to hold equitable title in an installment land contract. That's exactly right. Now, because that's a really good question, Misty, so let me just remind you of something, folks. Believe it or not, and I don't want you to confuse this on the test, but here's the funny thing. Equitable title is basically you live there and you will eventually own it. That's all equitable title is. It is this concept of future ownership, but you already live there. Which is why, but be very careful, in a deed of trust relationship in North Carolina, all of us who own homes, we are said to hold equitable title as well. Because we live there, we're treating it like our own, and we will ultimately own it outright. But because we signed that naked legal title over to the trustee, we are only said to hold equitable title in that deed of trust relationship as well. The key difference, though, in a deed of trust relationship, because you did own it before you signed it away, you can access your equity. You can take out second loans against the property. In an installment land contract, you do not own it to the extent where you can pull out equity. So if you were to get asked a test question and it said that a borrower in a deed of trust relationship holds equitable title, arguably that's true. A buyer in an installment land contract holds equitable title, also true. Does that make sense? Sometimes I'm like explaining these.
I agree with Misty. It's a little bit. It's a little difficult of a concept for me to grasp.
That's exactly what I was about to say. Sometimes when I'm teaching this stuff and I like hear it out loud, I'm like, man, this stuff's confusing. I mean, it is. So the thing about equitable title, I mean, let's just take the deed of trust relationship, okay? If you buy a house today in North Carolina, 123 Main Street, Monica, you are the buyer, I'm the seller. So I'm going to sign a deed, and I'm going to be the grantor, and you are going to be the grantee. So I just granted ownership to you by way of this deed, okay? Or this concept of title by way of this deed. You okay with that, right? Okay. So when you go to closing, you're going to sign a crap ton of lending documents that the attorney and the lender needs you to sign, promising to pay it back, making sure that they know who you are, that you haven't lied on your application, all these different things. And one of the other things that you're going to sign is the deed of trust. And so I signed this and that gave you ownership, because remember, the grantee doesn't need to sign the deed because you're going to pay me, I'm signing this over to you. But in the documents that you signed as a buyer, you signed a deed of trust where you are now named as the grantor, and you are going to sign away your ownership to this trustee, where they hold it on behalf of the beneficiary. So for all intents and purposes, this trustee is holding the legal title. And so you were the owner, but because you signed it away, you were said to hold equitable title. We can all agree that when you buy a house, you live in your house. You pay the taxes, you pay the insurance, you treat it as your own. And we can all agree that eventually, if you do what you're supposed to do and you pay off all your payments, you will own the house. That is all equitable title means. You're living there, you're treating it as your own, you keep paying like you're supposed to, you will own it. Does that make sense? So that's why we say that in this deed of trust relationship, you have equitable title. But the thing in this one is you can borrow money against it because you were the legal owner before you signed this right away, albeit for a second. Now here's the difference. Let's say that instead we did an installment land contract for 123 Main Street. Okay, you didn't get a loan, we did an installment land contract. So you and I agreed that you were going to make me payments every month over the next 10 years. We would draft up a document that would basically outline our payment structure, the interest, the maturity date, and we would record that against the property. But you're going to go ahead and move into the property. But if you look in the Register of Deeds, I am still named as the most recent grantee. I am the owner, so I hold legal title. But because there's this document that says, if you make all these payments, I have promised to convey it to you. You're living there, you're treating it as your own. You will ultimately own it if you do everything right. Just like the other scenario, you were said to hold equitable title. You will eventually own it. But legally speaking, the ownership has not been transferred to you.
Seth, I have a quick question.
Sure.
You said we make a contract, but I thought it had to be a lawyer made the contract.
Sure. Yeah, it's not us. An attorney. Somebody drafts it up. Yeah, no. We would never. We don't have that expertise, the ability or otherwise. But yeah, an attorney would draft it up. So it's basically a financing agreement and a contract simultaneously. And it does get recorded as a memorandum of contract against the property that will ultimately lead to a conveyance. Does that make a little bit more sense? Yeah, good deal. Don't be nervous, Jacob. Just get prepared. That's the best thing to do, right?
I'm terrified, man.
Mm-hmm. I'll let you know that the class test. There was a couple of people who absolutely aced it today. I'm talking like 92 and 98. I was like, oh my god. That wasn't the majority of the people, but there were some.
Jacob, don't psych yourself out. You need to have a positive attitude, because if you go in with a negative attitude, you're going to mess yourself up.
There you go. Stephanie, I'm going to hire you to be my life coach. You just wake me up every morning and tell me that same thing, right? It's going to be a good day.
I'm just telling you, I had to tell children that all while teaching them. If you go in with a negative attitude, it's going to be a negative outcome.
That's right.
If you have a positive attitude, your outcome is more likely to be positive.
I like how you were very careful. Not guaranteed, but more likely to be positive. I like that.
No, nothing's guaranteed.
You're absolutely right. There you go. Yeah, y'all are going to be in good shape. I mean, folks, the thing is, as I look through the test, because I compiled it. I didn't write all the questions. We have databases of questions, and I've kind of pulled it and put them together. And as I look through it, I'm like, I've taught my group this. 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 You got all the resources to be successful. The question is, did you have enough time to be successful? And that's the biggest question. Between balancing your work life, your love life, your life, your exercise life, did you have enough time to prepare for this class? It's going to be the biggest question. So here's the flashcard stuff, folks. Here's where we're talking about repayment plans, okay? Not necessarily the FHA, VA, all those different things. But there is different types of repayment structures. Yet again, you probably didn't realize this because most of us just use a very standard, fully amortized fixed rate loan, and we are just making consistent payments. But there is a lot more options than that exist depending on whether you're getting a commercial loan, a residential loan, what you're doing with the property, if you're an entity versus not. But these are all flashcards. You're just going to have to be able to say, oh, that's this. That's it. It's not going to be analytical. It's not going to be differentiation. It's remember what these freaking things are. Everybody with me on that? That's all this is. So let's start with a graduated payment loan, okay? Graduated, and the good news is this is very similar to a graduated lease. It is basically structured intervals of increase. So it may be something like for 3 years, your principal and interest payment is $1,600. For the next 3 years, your principal and interest payment is going to be $1,900. And then for every subsequent time after that, it's $2,200, or it could continue to climb. And so this is basically, in a way that you could pay it off a lot earlier than the standard 30-year mortgage, because as you increase the payment, well, your interest isn't increasing if it's fixed rate, but that's increasing the amount that's paying your principal down. So it could be happening a lot faster. Now, this would be an actual structure, not the same thing as just, making extra payments like we've discussed in some of the previous classes. It's called a graduated payment or graduated repayment loan. And there is also leases called graduated leases that work the exact same way. Your first 3 years of rent, or your first 5 years of rent, or the next 5 years, whatever, okay? Called a graduated. It's just step-ups. A package loan, folks, I want you to think of it this way. When you order 3 things from Amazon, what does Amazon typically do if they're all getting delivered at the same time?
Put it all in one big box.
Jacob said free shipping. This is true, but they are typically going to put them in one box, right? They're going to package them all together. So I want you to think of that. It's got more than one thing in it. And in this instance, the multiple things are real property and personal property. Now, most loans are only accounting for personal property only, but there are certain loans that account for, most loans only account for real property only. There are some that account for personal property. If you were purchasing a fully furnished Airbnb, folks, there's probably at least $20,000 worth of furniture in there. And so the banks would need to give it some value if you were trying to purchase it, including that. You would need to utilize a package loan to basically itemize the things that are in there and for them to figure out if they want a security agreement against any of that or if the real property is enough. Another big example of this, if you're purchasing a home that has a boat slip as well, a boat as well, or if you're buying land and a manufactured home together. The manufactured home is personal property, the land is real property. Package loan includes real property and personal property bundled together, just like Amazon throws your multiple things into a box together. But it is personal property and real property bundled together. So the next one, I'm going to give you a similar analogy here. The next one is called a blanket mortgage. And I want you to picture walking into your living room and finding the biggest, coziest blanket you own. Because you all got one, I know it, okay? And I want you to take your big old blanket and I want you to rear back a little bit and I want you to toss it through your living room. If the blanket's the right size, it's probably going to land on a couple of different things in your living room, isn't it? Your couch, your chair, your love seat, the TV. It's going to hit a couple of things. You agree? And if it doesn't, your blanket's not big enough. Get a bigger blanket. Here's the point. A blanket mortgage is a mortgage that covers multiple parcels of property. So this is very common with developers. Yet again, let's say that somebody owned land on this side of the road and this side of the road, and a developer wanted to buy that to make 2 phases of the same subdivision. They're not going to go out and apply for 2 loans. They're going to get a blanket mortgage. One loan that covers parcel A and parcel B. So just like you toss a blanket and covers multiple things, this covers multiple things. Different pieces of real property. The other way that this typically happens is after a developer develops the property, and puts a cul-de-sac, they will turn around and sell the lots they develop to a builder, and the builder typically takes them in what's called takedowns. So the builder will get a loan to purchase 10 properties at a time. That'd be a blanket loan too, because there are multiple pieces of property that are the collateral for the loan, not just one. It's called a blanket mortgage.
Seth, is that why a lot of subdivisions do things in phases?
Yeah, well, the main reason they do them is, think back to when we were talking about land use controls. We have those public land use controls and subdivision regulations that said you can market the lots once you have preliminary plat approval, but you can't close on them until you have the final plat map recorded. So most developers will do things in phases so that they can record phase one and sell it and make some money, so they don't go as long without money. Because once phase one is recorded, they can sell those lots to the builder. Then they've got some money, they keep working on phase two. Then they'll sell those lots to the builder. So they actually do it so they can get paid faster. Because if they were to do it all in one fell swoop, they can't get paid until all of it's done. But if they record that one phase, they can sell it. There you go. Now, growing equity, not too dissimilar from the graduated loan, in which the payments increase annually, applying additional amounts to the principal and shortening the loan term. That is just, you could basically do this by adding an extra payment each year or each month or something like that. But there are structures this way where every single year you are going to pay more and more and more, as outlined in your amortization, and the intention is to pay it off more rapidly than something like a 30-year. Because yet again, if it's a fixed rate, more gets applied to the principal. That's why it's called a growing equity. Because remember, the three ways to increase equity: paying down your principal, that's what this is doing, appreciation, and capital improvements. Next one on the list, construction loan. Folks, it is exactly what it sounds like. It is for construction. This is basically made. Now, let me clarify something. There are two different types of construction loans. There are loans made to builders, where they get money to build the house, and then they will turn around and they will sell that house and pay off their loan at that point. But there's also construction loans that borrowers building houses can get. Either way, they work very similarly. Let me ask you a question here to help you understand this. If you were buying a house for $400,000, but you borrowed $300,000, how much are you paying interest on?
$300,000.
$300,000. Now, folks, when they lend you money, you got to start paying interest. Well, building a home can take anywhere from 4 months to 2 years. So let's say that you go to the bank and you get approved for a $600,000 construction loan. If you take all of that money, they're going to start charging you interest on that $600,000. Why would you do that? You don't need $600,000 yet. So you get approved for $600,000, but then you take the money out in what we call draws. So you would use part of the money to buy the dirt. Pull out, $70,000. Start paying interest on that. You get another $30,000 for the foundation. Now you start paying interest on $100,000. You get $20,000 pulled out for the framing. You pull it out in draws, so you're only ever paying interest on what you have actually spent. Now, for a consumer, when you finish paying off the last one, let's say that you get up to, the cost of building your house is $500,000. This is typically where they will convert it into a fully amortized fixed rate loan for 30 years once you finalize it. For a builder, they're going to do a balloon payment, because the builder is basically going to borrow however much they need to build the house. You're going to get a new loan, buy it from them, and they're going to pay it off in a balloon payment. Both are construction loans. The biggest thing you need to know about a construction loan is you do not borrow all the money up front. Just because you're approved for it, you would take out draws and pay only what you needed as time went on. The contractor doing the foundation, the contractor doing the framing, the rough-ins, the HVAC, so that way you're never paying interest on money you're not using. This last one is a sale and leaseback. It's not so much a specific loan type, but it is a very commonly negotiated deal within commercial. So let me give you two examples of this. Sometimes business owners will have properties that they own, and maybe they're trying to expand into different markets. And so let's say that they have a building valued at $2 million, and it is their home office. What they might do is turn around and sell their home office for $2 million to get the upfront capital to use for other projects, and then they will negotiate just leasing it back from the new commercial owner. That is a sale and leaseback. This is also very common in new construction communities. There is typically a model home for larger communities. That model home is sometimes sold 6 months to a year before the final home is sold in the neighborhood. Why? Because they don't want to have to deal with that one at the end of it all. So they will typically market it as soon as it's built, and they will either move out of it or they will negotiate a lease back with the purchaser. So the purchaser will buy the model home, and then the builder will just lease it back and continue to use it as a model home until a certain date and time, like the neighborhood is completed. Very common. Sale and lease back. Jacob says, y'all do that. They do that, but it's the first house you sell. It's the first house you sell if you've got a buyer for it.
Yeah, well, it's the first one. So, I mean, from the very beginning, I mean, that's the house that we sell the very, very first. So it's never like on the market for anybody. It's not like we sell that one 6 months before the last home closes. We sell that before any other home in the community sells, and we lease it back for the entirety of the community.
Well, and that's what I'm telling you. I mean, I get that that's your intention, but what if you don't have a buyer for it? I promise you the builder would still build out the rest of the community even if you didn't have a buyer for it yet.
I mean, I'm sure that we would.
Yeah.
Yeah.
But, I mean, that's the one that you don't want to worry about after the fact. So they love to negotiate those leasebacks. You know how they sometimes sweeten the deal? I don't know if your builder does it, Jacob. Sometimes they'll sweeten the deal by offering the people the furniture in there. Now, if it's leased, they can't do that. But certain builders have bought the furniture, and so sometimes they'll leave $70,000 worth of really nice furniture that they've staged the property in. I've seen it happen. It's pretty cool.
Yeah, we do all of ours is like internal investment. So it's like people within the company get the opportunity to.
Yep. Yep, depends on the structure. A couple other ones that get thrown in the mix here. When we get into things like reverse annuities, and I can't remember if our class talked about this or not, reverse annuities, or in other words, reverse mortgages. A reverse mortgage is where you have a lot of equity in the home. And so as opposed to paying a standard mortgage where you're making payments to the bank to buy down, the money borrowed, they pay you payments based on equity you have, and then will typically get it back later. So this is something that a lot of elderly people will do if they've got a lot of equity and they don't intend to leave their house to somebody. But of course, if it's a house they intend to leave, it's not a good idea because they got to get that money from somewhere. So if they want to leave it to somebody and then they borrow $200,000 plus interest against this home, their heirs would have to pay off that debt before they could own the home, and that's leaving them with a huge burden versus leaving them with a house. But it is something that is a retirement vessel that it could be utilized appropriately. Very risky if you don't know what you're doing, though, because they will try to take advantage of you, especially elderly people who need the money. But that's not the main intention. A reverse mortgage, sometimes referred to as a reverse annuity mortgage. Now, the buy downs we've already kind of talked about. That kind of comes with the discount points, lowers initial interest rate on mortgage by seller. It's discount points, buying down the rate. Sometimes we can negotiate let me rephrase it. They, for whatever reason, call it a buy down if we are dealing with the seller. The seller paying for it, they call it a buy down. If the buyer pays for it, they call it discount points. For the life of you, I couldn't tell you why. It's the same freaking thing. It's just one's paying for it versus the other. But that being said, go take a break. Come back at 8:40. Whoop, whoop. So we are talking about just some miscellaneous loan types. As I said, everything we're discussing is what I would consider a flashcard level testable topic. You got to know what it is, be able to identify it, these kinds of things. So we left off at buy downs, and so discount points are upfront payments made by a buyer to increase the lender yield up front and decrease their interest rate. Buy downs are a very similar concept. A lot of builders are doing buy downs right now where they're paying lump sums directly to the lender as part of their negotiations. And so it'll be like a 5-year buy down or something like that. So it may not be, it's basically just buying down like the first 5 years. And so it'll act a lot like an adjustable rate mortgage. So when the sellers are paying for it, they call it buy downs. And if the buyer is just buying down the rate, they call it discount points. Like I said, don't ask me why, but that's what they do. Yeah, there you go. Jacob says the builder he works for is doing that, buying it down to 4.99 for, do you know how long, Jacob, by any chance?
We have a certain money amount. So we started off with I think it was 12 million. And then once we're out of that, we're not doing it anymore. So as of today, we only had 550,000 left. So next house, pretty much.
So next thing on the list is a bridge loan. Now, folks, just like I've been giving you these analogies, I want you to think same thing here. With a bridge loan, folks, what does a bridge do?
It's like a gap. It connects you from point A to point B.
There you go.
You have a pathway, right?
There you go. A bridge connects two different things. And so that's exactly how you can think of a bridge loan, okay? So let's say that you have a house and you've got plenty of equity in it. We'll call it house A. And you would like to move into house B before you sell house A. You can get a short-term loan called a bridge loan where they'll basically give you a lump sum based on the equity you have in this house. And you can use that for the down payment on this one so that way you can kind of bridge your transition. You close on your new one, and then when you sell off the other one, you've basically destroyed the bridge behind you. You paid it off. These are not long-term loans. They are higher interest rates because there's not something that's supposed to be paid off over a long period of time. It's, yeah, we'll give you $250,000 right now, knowing that you're going to pay it back in a month or two, and that $250,000 could be utilized to put a down payment on the next house. And so it is bridging the two kind of transactions together. Not common, not uncommon, depending on the buyer, the sellers, whatever they desire to do. There's lots of other programs out there that do similar things. This is a better way to go, though, because if you ever deal with those programs, and I guess I won't name any names, but there's programs that will kind of do the same thing. Oh, we'll buy your house and help you buy your next house, and then, you just have the money and you don't have to pay us until you sell yours. There's always a catch. There's always a catch. At least with a bridge loan, you know what you're, getting yourself into. It is an interest rate, and you're just paying it back, and once you pay your debt back, you're good. But that's a bridge loan. Borrowing money against a current piece of property that you utilize in the short term to buy another piece. When you sell it off, you pay it off. Flashcard level.
Quick question: does that bridge loan, the amount that's owed, does it in any way, shape, or form get listed in your closing? I keep thinking HUD, but it's not.
Yeah, absolutely. When you go to sell the property that you borrowed that money against, it will absolutely be a second lien payoff because you've already gotten that money up front, and so you have to reimburse it, and so that would reduce your net. So let's say that you were going to walk away with $300,000 from the sale of your house. You borrowed $250,000 in the way of a bridge loan. You're only going to walk away with $50,000 because you have to pay that back.
Okay, thank you.
Sure. So this is the next thing we've talked about, but here's where I'll just kind of, throw some verbiage on a piece of paper or slide, as it were, for you. We've been talking about mortgage priorities from the word go. And so mortgage priorities is what order are they getting paid out in, right? If you're the highest priority mortgage, you're getting paid out first. If you're in a secondary position, you get paid out second. When does this really matter? When there's a foreclosure. But of course, even when there's not a foreclosure, folks, think about it from a bank's point of view. If you're on position 4, 5, or 6, it's a lot more risky because if anything goes wrong, there's a chance you won't get your money. If there's plenty of value, plenty of equity, and you were lien holder 1, you're probably not that worried about it. So it is considered a higher risk loan to be in a second and third and fourth position for this lien priority. Not that it's a good idea to have that many liens against your house, but of course sometimes you do. And then remember, all liens in general go through this, pure race mentality, at least in North Carolina, first come, first serve, except for those highest priority liens. Folks, which liens beat out all others? What's the highest priority lien that beats out everything else?
Tax on property.
Real property tax liens beat out everything else. What beats out everything else second to that?
Special assessments.
Special assessments. There it is. Good on you. Yeah, special assessments. Now, I talked about this just a little bit ago. If you are the higher priority, we call it a senior mortgage. If you are a lower priority, we call you the junior mortgage. But I told you sometimes the lenders may want to change their positions. Don't worry about why. And they can do that with what is called a subordination agreement, where the lien holders agree that while I am currently sitting in the primary position, I will agree that you can get paid first and you will sit in the primary, I will take secondary. It's called a subordination agreement because we just basically have to go in and say, yep, I agree, I'm in the second position. Don't worry about why the banks do it. You don't even know that. But there's reasons. Stephanie, I'm going to mute you because it's getting to be that time of night where you start making the sound effects. When you come in fresh, you're silent. And then at the end of the night, you're like...
My hand is give out.
I hear you. So let's get into the other side of the financing world, okay? This is not nearly as testable, but of course it is. And these are things that, most of us probably don't even think about or care about in any way, shape, and form in our personal lives. But it does exist, and it's things that we have to understand. There are lots of governmental agencies, entities, operations that, control a lot of things that happen in our lives and otherwise. And no, I don't mean the Illuminati. That's for a different conversation, okay? But one of them is the Federal Reserve System, which we just call the Fed. And the Fed's job is to make sure that we don't have another depression, okay? Maintain sound credit conditions, counteract inflationary and deflationary trends. And so they're the ones who are sitting there and they're like, maybe we should raise interest rates to slow down the buying. Maybe we should lower interest rates to increase the buying. Maybe they're trying to control things to prevent recessions, which too late, and depressions, which we'll see. And so that's kind of the whole point of this. If you didn't realize this, folks, banks lend us money. Well, the banks borrow money from the Fed. They just borrow it at a cheaper rate. It's kind of like, think of it like Walmart. We all know that Walmart doesn't make the tires that they sell. A manufacturer sells them, called a wholesaler, and then they sell them to a retail store, and then they turn around and sell them to us at a markup. Money does the same thing. Banks borrow money from the Fed at a much lower interest rate than they turn around and lend it to us. So that's how they make their money. They borrow cheaper from the government, and then the government lets them lend to us at a higher rate, and that stimulates the economy because the banks make more money. The banks have more money to lend. They have to borrow less from the federal government. They have to pay back some to the federal government. It's kind of the way that this all kind of flows. So when we're dealing with, the consumer price index and where it sits and the cost of living and stuff, it all kind of streams from the Fed and their controls and regulation. So we've got the Fed, which is the Federal Reserve System, which is trying to regulate all of these. Well, then there's the other pieces, and this is more specifically for real estate. We have the primary mortgage market, and we have the secondary mortgage market. Primary being first, secondary being second. So the primary mortgage market, folks, is what you and I deal with. If you go out and you want to buy a home today, you're going to be working with the primary mortgage market, okay? The primary mortgage market is the lenders who are lending the money to the consumers who want to buy homes. That is the primary mortgage market. Now, do understand that I said lenders. Lenders are lending institutions, banks that lend money to consumers, whether it be for, mortgages, homes, or otherwise. Lender. But remember when we talked earlier on about the differentiation between the word broker, agent, realtor? Well, I told you, broker we utilize because you are getting a real estate broker's license. But if we take real estate out of it, folks, what is a broker?
It's an individual that's bringing, well, just like it says, they're bringing people to an agent. They're acting, oh geez, sorry.
Almost at it.
A broker is somebody who facilitates and brings two parties together.
There you go. Brings two parties together. One that wants to do one thing, one that wants to do the other thing, okay? And so remember, there are real estate brokers, stock brokers, mortgage brokers, insurance brokers. A broker is somebody who facilitates a deal between two parties. So a mortgage broker and a mortgage lender are not the same thing. A mortgage broker is a middleman that get banks who want to lend money to work out deals with borrowers who want to borrow money. If you've ever heard the old Lending Tree commercials, they were a brokerage company, a mortgage brokerage company, and it said, when banks compete, you win. That's what they do. They basically figure out what you want to borrow, and they would go talk to all these different banks to see which one matched your needs the most. It's a mortgage broker. Now, either way, mortgage brokers and lenders are both part of the primary mortgage market, but ultimately, the one we're most familiar with is the lenders, the banks that lend the money for us to buy the houses. And the way that they make money is from the interest that you have to pay over the life of the loan servicing fees, which whether you realize or not are built into the cost, and of course any upfront origination fees, discount points, and otherwise. This is the way they make money. Now, folks, yesterday, I think it was, or maybe the day before, I asked you if you would be willing to lend me $1. So I'm going to use another similar analogy to that. Okay, let's up it to $10. We're all friends. We're walking down the street, and I asked you if I could borrow $10, and you have $10 in your pocket. Let's hope that you all are nice and you let me borrow $10. How much money do you have in your pocket now?
None.
None. None. So another one of your friends walks up to you and says, hey, can I borrow $10? Can you lend that other friend $10?
No, because you don't have it.
No, because you don't have it. Welcome to the primary mortgage market versus the secondary mortgage market. Folks, it's hard for us to fathom because banks are banks, but even banks run out of money. They can only borrow so much from the Federal Reserve before they are capped out, and they will not let them borrow anymore. So let's say that instead of $10, it's $10 billion. When they have lended out all $10 billion, they can't lend anything else anymore. So what do? They will sell off these loans to the secondary mortgage market. And what that does is that frees up capital to continue to lend. Now, the secondary mortgage market is comprised of your quasi-governmental agencies, your Fannie Mae, Ginnie Mae, and Freddie Macs. Now, I say quasi-governmental agencies because they're not fully governmental, and in fact, most of them are publicly traded on the stock exchange at this point. But what they do is they buy these loans, and they will typically roll them into mortgage-backed securities for investors to buy into to collect on the interest. But when they do that, they have replenished capital for the banks to continue to lending money in the primary mortgage market. Now, it's not only these quasi-governmental agencies. There are other banking institutions that buy mortgages, and that still frees up capital for those banks. But most of the time, it's dealing with these quasi-governmental agencies.
Question, who frees up money for the secondary mortgage market, though? They never run out of money?
The investors. I told you, they roll them into mortgage-backed securities. Rich people invest, and they buy portions of these, and they collect the interest.
Got it. Okay.
Mm-hmm. Now, I'm going to be honest with you. I mean, there's like 10 billion different, discussions we can go down. It's not testable to that degree. It's really not. Now, this bottom note, and this is really, I think, more than anything, all you need to know. Your book will go into way more detail, but I just don't see it necessary. You know why? Because even at this point, this stuff confuses the hell out of me because I got so much else in my brain that's actually useful. This is like, I don't remember which one is which. The generalization is Fannie Mae, folks, stands for the Federal National Mortgage Association. So they gave it a cutesy name. It was FNMA. Federal National Mortgage Association. So they looked at the letters together and they said, oh, let's give it a more friendly name. Fannie Mae it is. FNMA. FNMA. That's how they came up with it. It just kind of sounded like it. So they said, this sounds less intimidating, so we'll call it Fannie Mae. Fannie Mae buys conventional loans, FHA loans, and VA loans. A little bit of everything Fannie Mae does. Ginnie Mae was actually the government mortgage administration or whatever. It's like Government National Mortgage Association, GNMA, versus the Federal National. So when we're dealing with Ginnie Mae, they only deal with government loans. G for government, think government loans only. Ginnie Mae only buys FHA and VA loans, the government-backed loans, the higher risk loans. And then Freddie Mac only buys conventional loans, if I'm remembering correctly. And like I said, Freddie Mac doesn't really even come into play in most cases. So, but this quasi-governmental agencies will buy these loans from the lending institutions. And this is where I told you earlier. They basically say, make the loans packaged like this and we will buy them. And so that's why we have underwriting guidelines in that respect as well. You have to meet all of their criteria, because if they were to lend on somebody that were outside of the underwriting guidelines, that means the secondary mortgage market wouldn't buy it, which means the lender had to service it their entire life of the loan. And some lending institutions only want to generate the loans, they don't want to service them. Other ones want to service them. It just depends. Now, I'm not going to play it in class, but I'll show you. There's a video linked in here that, I think it's a prep agent video. It kind of goes into some really good detail if you want to go into a little deeper rooted explanation on here. But I'm telling you that this is not...
The future of your business is here. With
Hold
this, you get advanced AI capabilities for more customization, more time, and more growth. Speed up your website copy with an AI text generator.
Sorry about that. I just wanted to show you what the video was. Yeah. What is the secondary mortgage market on Prep Agent? I mean, it's actually a really good video. It explains it really well. I don't think we need to watch it. But if you want to watch it and go into a little more detail, that's great. It's very easy to find. I've seen it before, but this stuff's not like crazy testable. You may get some very general questions about what the secondary mortgage market is, and that Ginnie Mae buys government-backed loans only. I mean, it's nothing crazy. So the underwriting that I keep talking about means that you have to meet certain characteristics for these to be available or desirable to the secondary mortgage market under most circumstances. What does that include? Of course, having certain credit characteristics, minimum credit scores. Now, I want to explain kind of this twofold. Yes, underwriting guidelines outline all of this stuff, but let me explain what it means for a buyer. The reason why we care about your credit score is because underwriting guidelines typically have a minimum credit score to even be considered for a loan program. Of course, the higher your credit score, the less of a risk you are, the better the interest rate you get because you're lower risk. The other things that come into play, of course, how much money you make, and more specifically, what we would call your debt-to-income ratio. So they want stability in your employment. Stability equates to 2 years typically. You have to have 2 years of stable employment. And so that means same job for the past 2 years, or same job title, different companies are okay. So if you go from a software engineer from Apple to Google and there's no lapse in time and it was just one to the other, you're typically fine. If you go from a software engineer with Google to a janitorial person for Apple, that's not going to fly. So they want stability of income, they want consistent income, they want 2 years of work history. And then the other thing is, folks, it's one thing to make a whole lot of money. But if you make a whole lot of money and you have a whole lot of debt, you still can't qualify for a loan. Think of it this way. If I told you that a business grossed $1 million, that sounds pretty good, doesn't it? It sounds pretty good on paper first, but then I turn around and I said their expenses were $999,999. That means they profited $1. They're not really doing well, are they? Same thing with you. You could make $200,000 a year. But if you've got 17 cars and 45 toys and 16 ex-wives and alimony and child support, you're probably not qualifying for much of a house, even though you make $200,000 a year. So all of these go into the underwriting guidelines to make sure that you even qualify and that you are not too much of a risk to take on. So keep that in mind, and we'll circle back around to some of the qualifying and buyer conversations in a little bit. Before we get there, let's talk about the legislation that we were talking about. Back when Jacob was in kindergarten, okay, and some of y'all were going through it with the housing market crisis, and Jacob was just mad that the cafeteria didn't have apple juice that day, right? But I digress. Back in the day, in 2007, 2008, 2009, there was what we call the housing market crisis. And let me explain to you in a nutshell why this happened. Have you ever seen the meme online with the 3 Spider-Men pointing at each other? You ever seen that one? Yeah, they're just you, no you, no you. Like they're all pointing at each other. It was basically that. But instead of 3 Spider-Men, it was the lenders, the appraisers, and the brokers. Here's what happened. Banks were lending money to anybody and everybody who applied for it. As I said earlier in the class, Jacob could have gotten a loan in kindergarten. If he would have just applied for it, they probably would have given him. So, Jacob, you missed your opportunity. They would have given you a loan back then, but you just were too young. They would have given a loan to anybody. And
I also would have not been able to pay it and shot my credit score.
This is true.
9 years old.
Very true. Yeah, it wouldn't have worked out. I get it. So they were giving loans to people that didn't qualify, right? And they were giving like $900,000 loans to people who made $30,000 a year. I mean, if you applied for it, they would give it to you. And so that was what we call subprime lending. They were giving non-qualified persons loans. What added insult to injury, the brokers were helping these people buy the homes. And so whenever they were offering $900,000 on this home or $400,000, whatever it was, we could pick up the phone and we could call an appraiser and said, hey, we need an appraisal done. And it needs to be at least $400,000. So you're basically telling the appraiser what value we needed. Not a subjective opinion, telling them what we needed. So brokers were helping people buy homes for who knows more than what they were worth. Appraisers were giving us whatever value we asked for. And lenders were giving loans to anybody who could ask for one. It was a cacophony for disaster, folks. And that is why we had the market crisis that we did. Because most people couldn't afford their payment, so they let their houses go. When they let their houses go, there was an influx of foreclosures. If your neighbor's house was foreclosed upon, your house wasn't worth anymore. So even people who were making their payments got hurt because their values went down because every other house on the street was a foreclosure. It was a mess. Now here's an interesting thing. We're going to talk about 2 big pieces of legislation in a moment. One is called TILA, the Truth in Lending Act, and one is called RESPA, the Real Estate Settlement Procedures Act. Here's the laughable thing. Both of those pieces of legislation have been around since like the 1970s. Here's the problem. Did you know that if no one is watching, some people act differently, don't they? There are some of us who will put our shopping carts back no matter who or who isn't around. And some of you are terrible people where you're like, Ain't nobody here. I'm just leaving in the middle of the parking lot. And the point is, nobody was actually watching to make sure that TILA and RESPA were being enforced. Yes, they existed. Nobody enforced it. If you've got a bunch of lenders trying to make the most money they possibly can, and somebody looks you in the face and said, well, we're not actually checking to make sure you follow these rules. Do you think any of them followed the freaking rules? No. So what did come into play from all of this crap was a big piece of legislation in 2010 called the Dodd-Frank Act. Now, Dodd and Frank were people. We don't care. We don't worry about them. It's just named after some people. That's not important. So it is a big piece of financial reform. And so what the main thing that the Dodd-Frank Act did, we called it like lender law legislation, but the Dodd-Frank Act actually created the CFPB, the Consumer Financial Protection Bureau. Folks, that's nuts. The CFPB, 14 years ago. That's it. That's crazy to think about. So the CFPB, the Consumer Financial Protection Bureau, was created as an oversight agency that looks over a lot of different of these government, quasi-government agencies, including the Fed, the Department of Housing and Urban Development, the FTC, and several others. 7 total federal agencies. So now there was this regulatory authority that was actually enforcing the rules and making sure that nobody was doing things that would screw up the economy, the market, or otherwise. And in doing that, they also became the enforcement agency for TILA and RESPA. So there were minor reforms to both of those pieces of legislation, and now they are very strictly adhered to. So the CFPB is the oversight agency for 7 major federal agencies, and they also administer all this legislation that did exist, reformed it, corrected it, changed it, and enforce it. And that includes, as I said, RESPA, which is the Real Estate Settlement Procedures Act, and TILA, which is the Truth in Lending Act. Folks, half the battle for those is remembering what the names stand for, because they may just say TILA on the test. They may just say RESPA on the test. Well, if I say real estate settlement, what am I talking about?
RESPA.
Well, yeah, but I mean, generically speaking, take the law out of it. Real estate settlement. What is a real estate settlement?
To purchase a house.
Yeah. Statement they purchased, well, real property, right?
Yeah, it is when you go to purchase real property. Now, folks, let me explain something to you. Not all real property purchases fall under RESPA, the Real Estate Settlement Procedures Act. Only certain transactions do. Specifically, residential involving a loan from a federally backed depository. So most transactions fall under RESPA because we can all agree that most of us are buying it to live in, and most of us are borrowing money from a bank, which is an FDIC insured depository. You agree with that? So here's where I'm going to make something come full circle, right? Stephanie and I have been joking about math this whole time, and, bless everybody's hearts for not understanding how much money they're paying and, making bad decisions. But folks, that's the whole reason these exist. The whole reason these exist, no offense, is because 99% of the population is a moron or apathetic. Nobody cares enough to do the research to figure out what things are actually costing you. Credit was a relatively newer concept back in the 70s. And when you introduce something that had never existed before, like credit, a lot of people didn't know how to use it. And so they got themselves in big trouble. And so in order to prevent people from going bankrupt and broke and all these, basically these are disclosure laws. Let me tell you how much this costs you so you don't make a stupid decision. But as much as that's what these are attempting to do, how many people are just like, all right, where do I sign? Don't you want to know what's going to cost you? No, just give me the pretty house. Where do I sign? Just where, right here? Just 3 times, 2 times? First name, last name? No. So the whole point of these is to actually help consumers make educated decisions by giving them the information of the actual costs associated with it. Now let me tell you where things evolved. RESPA deals with buying real estate, as the name implies. So here's where I was going with that. TILA is the Truth in Lending Act. RESPA is the Real Estate Settlement Procedures Act. So TILA kicks in anytime you're borrowing money. Anytime. Well, what had happened was RESPA required two forms of disclosures to be given to consumers. Disclosure. TILA required two forms of disclosures to be given to consumers. I'm just going to call it a disc. Can we all agree that if TILA applies to every time you borrow money, and then if RESPA applies when you borrow money for real estate, that every RESPA transaction was also automatically a TILA transaction? Yeah.
Yes.
Nobody bothered to realize this initially because nobody was enforcing these laws. But once the CFPB started enforcing them, they started realizing, they said, wait a second. So that means anytime somebody buys real estate, we got to give them two disclosures to be in compliance with TILA and two disclosures to be in compliance with RESPA. And these disclosures do the exact same thing. No, let's make this easier. And that's where they came up with what they call TRID. This right here, TRID. TILA, RESPA, Integrated Disclosure Rule. It was redundant to provide four disclosures that did the same thing, and so they basically created a combined set of disclosures that met the needs of both. So when I say closing disclosure, it is basically the disclosure given to you before you make your purchase. The one that you get at the beginning is called the loan estimate. You apply for a loan, you get a loan estimate at the beginning. Before you close on the real estate loan, you get a closing disclosure which says, does this look like what we quoted you? Does everything look fine to you? And are you sure you want to close on this property? Now, let me give you an example of TILA in action before I take this any further. If you are driving in your car and listening to the radio and you hear a car sales ad come on the radio and they offer you these fantastic deals of only $5 down to get in a new Mazda, what always happens at the end of that commercial?
Disclosure.
Say it again?
Disclosures.
Disclosures. Yeah. Not all buyers will qualify. Subject to credit approval. 2.9% is for qualified buyers with a 750 credit score or higher. Total interest paid over the life of the loan. You know, they go into all this information. Folks, that's TILA in action. Anytime that somebody is trying to advertise something that is a loan term, we call those trigger terms. And they need to give you more information, like the true cost of what it's going to look like. So if they say on a car commercial, only $1 down, well, they're giving you a very specific loan term. Your down payment is only $1. You need to give us more information. Now understand that these both have different things they could be called. RESPA is also called Regulation X. TILA is also called Regulation Z. Now you could absolutely see those on the test. If you get down to the nitty gritty, Fair Housing and ECOA and all these other like regulations and legislations, they all have their own regulation letter accompanied with them. The only ones that I really think you need to know on the test more than anything, Regulation X is RESPA, Regulation Z is TILA. They will test you on those. Now, before I take this to the next slide, I will point out this one, okay? You don't have to trust me on this, but I'm telling you the truth. When we say your interest rate, that is your annual interest rate. How much interest you're paying on your principal balance every single year. But you don't pay it yearly, you pay it monthly, which is why we divided it by 12 in that amortization math. But if you see APR, your annual percentage rate, it is typically a little bit higher than your interest rate. Why? Because an APR is actually all-encompassing. It's given to you as a percentage of all costs associated with the loan. meaning any origination fees, any buy downs, any, funding cost. Those are all included in an APR. So an APR is not a trigger term because an APR is all inclusive. All numbers are accounted for in the APR. Just giving you the interest rate, though, that would be a trigger term because that's not telling you everything else. And if you don't believe me, later tonight when you're ready to go to sleep, Google the difference between interest rate and APR. You're welcome. You'll be asleep in no time.
That's what I was about to ask.
How do you? Will it put you to sleep? Yes, it will. Go ahead. Googling it right now. You look like you're Googling it, Jacob. Yeah. I'll give you a second on that. So, this is what we call financial legislation. This is definitely testable within the financing concepts. You do need to know these terms. You do need to know some of these things that we're talking about. I am going to kind of break them apart and take it a step further now that I've kind of given you a blanketed understanding of this. Regulation Z is TILA, and it deals with the true cost of obtaining credit. How much does it actually cost you? And this is where I told you, when you understand the interest paid over the life of the loan, helps you understand the true cost of obtaining credit. It's great for somebody to say that you can borrow $20,000, but if it costs you $40,000 to borrow $20,000, folks, that's stupid unless you are in dire, dire need. The problem is people borrow money when they don't actually need it because they want to live a more lavish lifestyle. What they're doing is they're borrowing from their future happiness because they will never get caught up. They have accumulated too much debt and they can't get out of that hole. So this is the whole point. Disclosures to help you understand what you are getting yourself into before you borrow the money. Truth in Lending Act deals with all lending. So anytime that you get quoted a specific term of the loan, the down payment amount, the number of payments, the interest rate, the amount of your payment, any of these would constitute trigger terms. So let me give you an example of what you could see on the test. Okay, only $1,000 down. That's a trigger term. We need to give you the rest of the information. Monthly payments as low as $700 a month. That's a trigger term. Now you got to be very careful on the test. They will try to trick you with specific numbers that are not trigger terms, like HOA dues of $300 a month. Well, that is a specific number, but do your HOA dues have to do anything with lending? No. The other one that they'll get you with is closing costs. Seller paid closing costs of $2,000. It's a specific number, but it has nothing to do with lending. It's just a fact that the seller is willing to give you $2,000 towards your closing costs. So it has to be a very specific number, specifically relating to loan terms. Vague things are also okay. Low down payments available. Low financing. High loan to value ratios. No down payment possible. Vague generalizations are okay. But telling you a specific number of the payment, amount of payments, interest rate, and how many payments, any of those would trigger tell us more. The exception to that is, of course, the APR. The APR is all-encompassing. It's not a trigger term.
I looked it up and I couldn't find anything other than the short version you already told us.
That's exactly right. That's all you need to know. Basically this right here, right? The APR is not the interest rate. The APR is the full annual cost of credit and is typically higher than the interest rate. There you go. That's what you need to know about the APR. So the 4 chief disclosures, the things that we need to know, is the APR to tell us the big picture, the finance charges, the total number and amounts of all payments, and the total amount financed. These are the things that we need them to tell us in the disclosures. So let me give you some examples, and you tell me if it's a trigger term or not. Well, this first one, low down payment. Is that a trigger term or no trigger term? No trigger term. It's like, no, not a trigger term. It's not. No. How about the second one? Only $2,000 down.
We need more information.
They need to give you more disclosures. They need to get, so that is a trigger term because that is a specific down payment. $1 down, $2,000 down, $10,000 down. That is a specific number of a down payment, which does deal with lending. So that would be a trigger term. How about low monthly payment? Is that a trigger term?
No.
Generalizations are okay. They're vague. We're not giving you any specifics. How about monthly payment only $1,000?
Yes.
Yes.
Trigger term. There you go. Need to give you the rest of the information. Now, of course, one of the biggest things that comes into play is lenders and advertising. As long as we're just advertising the house and we're not trying to tell you how you can afford it, we really aren't going to violate this. Lenders can by telling you, oh, you can get into this house for as low as $10,000 down or something like that. So that is where we've got to work very closely with our lenders to make sure that in the real estate world, we're not advertising anything that would constitute a violation of the Truth in Lending Act. So TILA, Truth in Lending Act, deals with all loans. Then we've got the other one I told you about, RESPA, which is the Real Estate Settlement Procedures Act, dealing specifically with real estate. Now, I told you it's for residential. It does not apply to commercial. And it is also for, well, lending purchases, okay? You've got to be borrowing money. If you're paying cash, RESPA doesn't apply. If you're getting a loan from a private institution that's not federally backed, RESPA doesn't apply. But if you're buying 1 to 4 unit residential property from a federally backed depository, you're borrowing money, then it would trigger all of the requirements of RESPA. Now, RESPA really is just TRID nowadays because once you hit RESPA, you're dealing with TRID, TILA RESPA Integrated Disclosure Rule. And so some of the rules in it are when you apply for a loan that falls under the criteria of RESPA, they have to provide you with, it's called the Shopping for Your Home Loan book or toolkit. So understand that there's a publication they have to get you, which is more information on shopping for a home. So you could see it called the Home Loan Toolkit, Home Loan Booklet, Shopping for a Home Booklet, Shopping for a Home Pamphlet. They could call it a bunch of things, but that is a requirement for them to give you this home loan shopping toolkit, booklet, whatever. It's just more information to be aware of what you need to know. Now, there are also requirements and limitations, but then there's also timing things. So part of RESPA states that when you get your loan estimate, you apply for a loan, they have to give you your loan estimate, the estimation of all the costs within 3 days of loan application. Now, folks, that is business days. And for the sake, this is the crazy thing. I'm going to tell y'all something right now that kind of sucks. When you Google business days versus banking days, most legal places determine that they are the same. Most people will tell you that business days and banking days are the same and that they are Monday through Friday. However, I don't know if they're going to screw with you on the test, but please understand that in regard to the TRID rule, Saturday is also included a business day. So just know that.
So banking days is Monday through Friday, but business days is Monday through Saturday.
For the sake of RESPA and TRID and TILA, yeah, it is Monday through Saturday. But I'm telling you, if you Google it, every single thing that's going to pop up is going to say they're both Monday through Friday. But for the sake of like the TRID stuff, it's Monday through Saturday for business days. So you apply for a loan, and if you are going to get approved, they have to give you a loan estimate within 3 days. It is the estimate of all costs. Now, when they give you an estimate of their costs, the things that they control, like their origination fees and things like that, those have a zero tolerance for adjustment. They cannot change those. But there are other fees that they estimate that are not in their control. We call those services the borrower can shop for. So they put in generic estimations of standard attorney fees, standard title insurance fees. Those can fluctuate because it's just an estimation. You're in control of that, they're not. Now, before I go into the actual loan estimate a little bit more in depth, we kind of talked about kickbacks in the agency section, and I mentioned this. I told you North Carolina rule states that you can collect kickbacks, referral fees, and rebates so long as you disclose it to your principal in writing and so long as it doesn't violate this, RESPA. And RESPA states that you cannot give or receive kickbacks from any settlement service providers, attorneys, lenders, title insurance companies, surveyors. If you were to collect a kickback from anybody who is required as part of settlement, it's a huge violation of RESPA. Big, big penalties. Now, I haven't explained it to y'all yet, but when we were dealing with the pity payment, and I told you that the banks ask for money from you at closing to open up your escrow account. You remember me saying that? So they take money from you and they say, we're going to hold on to this money at closing. We're going to open an account for you, and then we will collect taxes and insurance each month. Well, RESPA also creates limits as to how much money they can take from you at closing and hold in that escrow account. So if they ever get a surplus or they try to get too much at closing, they can't do it. They would have to back it back. And so let's say that, maybe they take too much, they're holding too much, it keeps climbing and they don't need it. They would have to send you the overages on a regular basis. They couldn't hold it. There are limits set on how much of your money they can hold in their escrow account under RESPA regulations. I'm going to switch it to the next slide, but I'm not really going to talk about this, but I kind of already did. The loan estimate must be given within 3 business days, excluding Sunday and national holidays, but Saturdays are included. Now, here's the deal.